Well, good evening. Welcome. My name is Roy Maddox, and I, along with Wesley Maddox, are the co-host for the February Valentine Day, one day late meetup group. We're thrilled to have you tune in to us tonight. We're looking forward to sharing a lot about what's going on in the market today. Market's getting increasingly positive, and we're looking forward to hearing what you have to say as well. So this will be an exercise in which we all learn something tonight. So thank you for joining. This meetup group has been in effect for many years. I've been the host for, I think, 5 or 6 years. We've got 2,000 participants and members all across the country. So we'll probably have people tuning in tonight from Texas and New York, Hawaii, California, Charlotte, just all over the place. So we're looking forward to sharing with you tonight. It's going to be a lot of meat and potatoes tonight. This is going to be one of the first times we're going to concentrate on what Wes and I think are the top 20 setups in the market today. So we're not going to spend a lot of time on the macro environment. We're going to get to the meat and potatoes and see how we can position ourselves to make money in this new market uptrend. Again, we've got 2,000 members. This meetup group is designed to spirit enthusiasm for investing. It's based on CanSlim concepts, and it's sponsored by Investors Business Daily. So with further ado, let's get going in the presentation. Okay, does everyone see the screen, the meetup screen? Just give me a raised hands or a yes. Okay, very good. What we're about, again, this is a very vibrant and active community in Charlotte. What's nice about the pandemic, if there's something nice about it, is we've incorporated Zoom, so we're able to talk to people all over the country, and we certainly have a diversity in terms of mix, in terms of members. We've got many experienced investors that will be on this call tonight, as well as a number of novice investors as well. So welcome if you're new or here for the first time. This is our disclaimer. Remember that all the techniques and tactics and stocks that we talk about tonight are not considered as a recommendation to buy. Please consult your professional investment advisor or, to make those decisions. Many of us are aware of the CanSlim acronym that was pioneered by William O'Neill in the 60s and 70s. William O'Neill was ahead of his time, one of the great traders, one of the great market wizards, and he developed this acronym that really allows you to focus and identify the true new market leaders in every market cycle. All of the concepts that we're talking about tonight are featured in the book, How to Make Money in Stocks, which is a bestseller, which has sold over 2 million copies. And that is really the basis of our investment strategy. We believe that you should have a process and not just invest haphazardly. You should look at and consider technical analysis, fundamental analysis, and macroeconomic analysis. Now, what are technical analysis? They're simply tools that we use to identify volume changes, rate of changes, momentum characteristics, and so forth. Things that are used commonly might be the MACD, price phase, relative strength, stochastics, point figure analysis, and the trend. And the trend is really the most important. It's the most important metric in terms of making money, because the trend must be positive for you to really make a lot of money in the market. And the trend, if you follow the trend, you can ignore the noise that's out there. Right now, the noise happens to be the macroeconomic environment, the market is turning despite higher interest rates, despite the Fed raising presumably 2 more times, and the market is shaking that off. But most importantly, the short-term trend as we see it is identified when the 10-day EMA exceeds the 21-day EMA. The intermediate term trend is positive when the 21-day EMA is above the 50-day, and the long-term trend is positive. We use Stan Weinstein's method when you're above the 30-week, and I like to see a close above the 30-week moving average for 2 consecutive weeks, and then the 30-week moving average turning up. Well, tonight Wesley will talk about concepts in terms of breadth, how we identified the breadth of the market, and we'll show how the breadth of the market has changed and improved over the last month. We'll also talk about sentiment. Hold on, let me mute that. Well, Wesley will also talk about sentiment and some of those concepts, and we'll also talk a little bit about the ratio analysis. And again, this is a little better breakdown on our fundamental analysis screen, so you can see what we're really focusing on in terms of identifying the strongest fundamental stocks in the marketplace today. In macroeconomic analysis, we're partners with Hedgeye Research. We buy their research to give us an idea in terms of the macroeconomic trends in the market. And Hedgeye, their models are showing that we're in a quad 4 environment. And what that means is that you can see in a quad 4 environment on this screen what equity sectors and what factor exposure perform best in the current economic cycle that we're in currently. Okay, we've got I think 3 or 4 great slides here, and we wanted to put everything into context because we have had the most devastating bear market since the 2007-2009 great financial crisis, primarily in growth stocks. And you've got to go back to 2000 to 2002 to see really see a bear market that's been exceeded only twice since 2002. And we've just come through that type of bear market. But this chart is showing, this is a 30-week moving average, and it's showing you the upturn in the market. Notice the market bottomed in October of 2002, but it took another 6 months before the yellow line, which is the 30-week, turned up. Now, when that happened, when the markets bottom, you typically don't have a lot of new leadership. The first thing that bounces off the bottom are the stocks typically that have been destroyed the most. And in today's current environment, that would be things like Roku, Twilio, really Cathie Wood's stocks that are down 70, 80, 90%. Those typically bounce first, and then new leadership shows up. The real leadership, the institutional quality leadership shows up. And that's what we're looking for. And finally, after the market bottom that we've just experienced, I'm seeing new leadership show itself, and we'll cover a lot of those stocks tonight. So you can see this is the 2002, 2003 major bottom. This is the 2007 to 2009 bottom. Notice the rollover of the 30-week. And again, our long-term models suggest that the market is in a market downturn when you close 2 weeks below that 30-week moving average. So you can see if you use that, you would have dodged much of the damage in 2008 to 2009. And notice the upturn in April of May in 2009. That's when really new leadership presented itself. So there's always a lag there as the market just readjusts and resets. Now, what does it look like today? This is what it looks like today. We're right off the October bottom. We've had a move, and then you can see we had a recheck, moved up to 4,100, had a recheck to 3,700. And really, in only the last 3 weeks have we seen great stocks breaking out now, the last 10 days. So for the first time, we're very positive about the market in terms of looking at individual stocks and not the indexes. Notice the 30-week has moved up. So we're becoming more and more confident that we have seen the market low. And not just because the indexes have turned, but because we're seeing individual stocks that present themselves. And of course, this is looking at the NASDAQ, the 2021-2022 bottom. You had the first move off the bottom in stocks such as Microsoft and Tesla and Apple. And now you might expect those to come in, consolidate, digest, while the next new batch of leaders assert themselves. And that's what we're looking for. We're looking for the true market leaders that can double and triple over a market cycle. And by a market cycle, most true market leaders last about, well, you've got 13 weeks between earnings, and you typically have 8 beat and raised numbers for the quarters. And that really constitutes what the average true market leader does in terms of the length of its run. And that's about 104 weeks. So we're really, I think, 2 weeks out of a potential 104-week bull market cycle, which is quite exciting. And with that, I will turn it over to Wes, and Wes will take you through the rest of the slide deck. And then when we take a break, we'll come back and look at what we think are the top 20 best setups in the market today that we think are viable. So Wes, let me turn it over to you.
All right, thank you. And yeah, just stop sharing and I'll thank you.
Okay.
All right. So yeah, I'll go through a few things. Like we mostly breadth is kind of the most notable thing that we're going to hit on here. Just because we've seen such improvement there in the last month, and then I'll go through sort of what we always look through the back of the the back part of the presentation, and then get to the good stuff, which is really those stock setups that are encouraging for the first time in a while. So so we'll go through this, and so this is something we pulled from Ryan Dietrich, who shares these interesting little statistics every once in a while, basically every day. But he's showing that after a big January, right? We had a great start. It was a great January. And this is after a previous year decline. We usually have some pretty good full year returns. So not that many observations of this occurrence, but still, it's some positive anecdotal information. You'll notice that, even 2019, right, we were up 7.9%. These are really, positive Januaries. There's still a lot of room to go, right? So there's another 20% in 2019, another 20% or so in 1975. And so, just still, it shows that despite a strong start, of course, there's certainly lots of upside. And, ideally with some of these stocks that we're going to find and hopefully hold through the full year, we can do much better than that sort of index return. That's just that 20%, which that the first year out of a bear market certainly has some very good potential in the index as well as especially the individual stocks. Okay, and then some other information. We're just looking at the 4-year presidential cycle composite. So new year, kind of where we are in that third presidential year. You can see that directionally, we are in a seasonally or I guess cyclically positive year based on the presidential cycle. We're right, right in the beginning of it, and it looks like, based on this, just the cycle work, for this one, it peaks around the middle of the year. So, hopefully we can see a little bit of that trend, that, that positive seasonality play out this year, and get us through June. Okay, and this is an environment we've been looking at throughout last year, kind of considering what kind of Fed backdrop are we looking at and what kind of market environment can we expect to be in. Perhaps this is the right analog to be using. This is 1994 to 1996. And it's just showing that, okay, 1994 was a tough year for the market, for the S&P 500, really flat to down for the entire year, choppy, not a lot of progress. And notice the Fed funds rate creeping up the entire year from, let's say, 2.75% to over 5.5%. And then right when there's a pause, right here, that, let's say, 5.75%, the market takes off and it's off to the races right there. That could be the environment that we're going to see here, right? Like, it's been very telegraphed by the Fed, and the market kind of understands what's going to happen with the Fed funds rate. We're going to see significantly slower increases, which I know it's not quite a pause, but the market's pricing in a pause by June or July this year. So maybe, we're getting a little bit of ahead of that and discounting the Fed pause, and that might be all it takes here. So just a helpful example. And then notice in 1996, the Fed starts to cut. There's a little bit of volatility, but still a pretty strong market in that following year with cuts. Okay, and this is a big table of all the Walter Deemer breakaway momentum signals. If you guys are on Twitter, you may have already seen this 20 times when this signal kind of was activated, and Walter Deemer himself, I think, tweeted about this. But it's when you look at the ratio of advancers to decliners over a 10-day period, and when that gets above 2. So it's consistent, advances outpacing decliners for 10 straight days, basically. And that breadth is kind of a powerful indicator, and can often be a timely signal that a bear market or a bull market is really beginning. While there are plenty of technical indicators that you may have also seen in the middle of January that were signaling overbought, this we just have to see how that overbought kind of condition works itself out. And a lot of times, we'll see a quote from him that the beginning of a new market advance is when markets are most overbought. So here's all these indications of when it happened. It happened 25 times since 1949, and just a really good positive return environment following these periods for the next 12 months. An average return of 20%. So that is higher than the tip. Maybe the average year of the S&P is maybe 10%. Going back the last 70 years. So really positive development to see. And you can see a year out, the one time that occurred was in 1987, where you had negative returns a year out. And there was obviously a horrific crash in October, and the run up to that, however, from January to maybe early October or September or something, was quite a run leading up to that. So it's just a lot of momentum, it's one reason, and an important reason, why we've gotten more positive on this.
Wes, let me make one point if you'll back up also.
Okay.
And guys, look at this. Remember the March 2020 bottom of the last bear market. Remember, that was March 2020, but the signal didn't occur until June, which was 3 months later. So that was really the confirmation, the corroboration, this signal here that's led the momentum, that led you to believe that we're in a new bull market. So this is, we had just the same signal 1 month ago. And remember the NASDAQ bottom December 28th of 2022, essentially at the end of the year. So we're only really four to 5 weeks into this new market uptrend. And we're just now starting to see the stocks that we think are going to double or triple. And back in the beginning of 2020, that market bottom, you had many stocks that doubled and tripled, such as Livongo, Teladoc, Zoom, Datadog, really a lot of Kathy Wood's stocks from the March 2020 bottom. So that's where we are. That's where we believe we are in the cycle. We think things have changed. The market is shaking off the bad news, and we're beginning to have the ingredients that are necessary based on the trend that we're in a new bull market.
Great. Yep. And so this is just I think it's a great visualization. You can see every time that these signals occurred, and there's several very timely, I think, and signals here, right, where it really precedes a strong run up following kind of brutal bear markets. So I think it has a very good track record. You can see in 2009 when we got three of those momentum indicators. In 2016 we got a couple. That's 2020. I guess that's 2018. So yeah, I mean, this has I think it has a very good track record, and just visually you can see that here. And this is something not too valuable, I don't think, but it's interesting to me. So I wanted to point it out. It's interesting that I think 10 occurrences happened in January. That's 40%. You would think if it just, I don't know, it shows some kind of importance to the calendar here. Just that breadth would improve so dramatically in January most frequently is interesting to me. It just makes me think about how human markets are, and just it's like a reset, right? Everyone kind of has a reset and wants to reallocate. And so I just think it's interesting to call out that it shouldn't have this much representation if it was so if it was independent of the time of year. Okay, and just want to highlight, a very little on the macro, which is the CPI, which we know came out Tuesday. We're just looking at the reaction to the market at this point, right? We expect CPI to decelerate. Inflation is coming down, and it's just promising to not see a completely volatile day on these, right? I mean, maybe there probably was some choppiness on that. Was it Monday or that came out? But anyways, this is still obviously like front and center of people's minds, and where this is going to go, and if it's going to be sticky. And if it's going to be sticky, the Fed's going to have to raise more and more and more. But we're clearly down. We're down almost 3 percentage points on a year-over-year basis from the peak in June. I mean, there's clear progress here. And then something to point out too, as we look out to February, March, April, May, and June, the first half of the year, that's when you're going to see the comps, I guess, get a little bit easier, right? So up until June, right, when we're comping a 9.1% CPI report in this June, obviously we should see, that's going to be very, very favorable as far as seeing a bigger decline in year-over-year CPI, right? So that's going to be on our back, I think, the next 5 months that we get this number reported. Until then, then comps get harder again, and we'll have to see if there's more underlying, improvement in inflation. But I think that does kind of clear the deck a little bit, where we should see inflation steadily decline at least through June this year.
Hey, Wesley, it's Larry. I got a question for you, and I think you're getting to that. We've had 3 hot numbers in a row: the CPI, the retail numbers, and the last jobs in the last week. We're all way above expectations and market trend. What do you think effect that's going to have? Because to me, are people just looking beyond how amazing this initial steps to this run are. Because to me, this is what overheating looks like, and the need to continue to raise interest rates.
Yeah. So yeah, I mean, I understand that, and a lot of times when you get news, like when you get bad economic news, and that's good for the market, and because it means stuff with the Fed. Now the opposite you would think should be true, right? You would think, okay, good news means a tougher Fed, which is bad for the market. I guess as we've seen this happen, though, the last three things, like you mentioned, all three of these really recent things, the market shrugged it off. So I feel like that's got to be the most important thing to consider. I don't think that you can necessarily get inflation down 2% without labor market like weakness showing itself. I don't think that. I feel like you are gonna have to see some, but it is the most lagging indicator, like we've talked about it, before. But we might have to hike a couple more times. I feel like that's kind of the uncertainty in the back half of the year. Like what I was trying to say, with inflation, I think we have a clear path that we are going to decelerate for the next 5 months on a year-over-year basis. And we might keep creeping, we might keep having to creep higher on the Fed funds rate. But I don't know. I mean, when we get to this level, 5.25, I don't know if a quarter basis point is going to change what the market does. I can't imagine it's going to like 6-7%, in the Fed funds. So we've already made so much, we've already done so much, right? We've gone from 0 to here. It's hard for me to imagine. What do you have to add, Roy?
Yeah, that's Powell's line, that we've done so much so fast, and let's slow down a little bit. But it seems like, since the theme of the second half of tonight's chat is about the 20 best setups, it looks like you guys are buying into that the market news is secondary to the market events.
Yeah, we are. We have to go with the setups and the momentum. We can't imagine the market not going into a recession based on the yield curve, and we'll have a few slides on the yield curve inversion. The market's never gone into a recession with the yield curve inversion that we're experiencing right now. And we can't imagine the economy not slowing down and feeling the impact of these interest rates, but the market's ignoring that. And you're seeing the great leading stocks coming out of this market downtrend exert themselves. So we're going with the stocks here. We think the environment has changed. Now, what's going to be fascinating, and what you'll have to monitor, is when we have the first major pullback of 3, 4, 5%, and you want to see these stocks that we'll talk about tonight. You want to see these hold up and not have 8% drawdowns. You want to see them just get tight, hold up, and that will be additional corroboration and confirmation. So that's what you should look for. So we're looking at the momentum of the market, not the macro here.
Thanks, guys.
You're welcome, Larry.
Yep. All right. So then if we just pull up some of the charts we go through every month, this is just a S&P chart. Notice the downtrend line breaking, in the middle of January. This golden cross, the 50-day crossing the 200-day. So also the other moving averages that we talk about, all being kind of in lockstep with each other, right? The 10 above the 21, the 21 above the 50, and now the 50 above the 200. So technically, right, we're looking at an uptrend. We notice this high being taken out, higher, we're making higher highs, we recheck, and so far so good, right? We're bouncing off the 21-day just like you want in any kind, in a normal environment. Accumulation here too, right? Higher volume blue days, the pullback with lower volume. So this is what we're following the a couple of trend indicators here.
Yeah, and everyone on Wall Street's following, they're watching this. You can see this 41.95 area. So a break of that to the upside, and you step on the accelerator a little bit right there. So that could, we're just in an interesting area where we could go sideways, but you take out 4,200 and you're going to see many of the stocks that we talk about tonight, they're going to put on the afterburners.
Yep. Okay, and I think well, Roy, you may have tweeted about this too, but we were talking about how the technical indicators kind of showing you're in this overbought condition at the beginning of February, and the MACD is kind of I guess just on a sell signal here technically too, with momentum waning. We just want to see how this digests, right? The NASDAQ. I pulled up the Dow Jones too with the MACD, just because this was similar. Just seeing the MACD show how overbought the Dow Jones was back in the beginning of December. And this is how you really want the averages to behave. Although we're trying to not stare at the averages, but look at the stocks. But still, this is an orderly pullback. Where volatility has slowed down a little bit, and it's finding support, so it's working through that that overbought moment at the end of November.
And back up one slide, Wes, let me make a point right here, guys. IBD, they developed something called the power trend, and that's when you have 10 consecutive days above the 21-day EMA. You've got the 10-day over the 21-day, and you've got the 50-day has turned up for 5 consecutive days. And from that bottom right there, Wes pointed at the bottom there, that December,
Here.
right? The blue accumulation change right there. That's where the power trend started. So 10 consecutive days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's when the power trend went into effect, right? The next one right there. It confirmed right there. And notice we had an early turn where the short-term trend changed, the 10-day over the 21-day, 21-day over the 50. You went into the power trend, and the power trend stays in effect until you have a 10% correction, or or the 21-day break turns below the 50-day. That's how it would end. And that's what happened in the 2020 bottom. We had that power trend set up just like this, which shows you the momentum begets momentum. So you can see in this chart, you take out that 12,250 area, and if we do that, we can go sideways here. The PPIs tomorrow, the market can digest, but we're definitely in a short-term, intermediate-term, long-term uptrend. And you're going to see shorts cover additionally taking out 12,250, and you're going to see the leading stocks take off as well. So we're really at an important junction, and this is the best environment that we've been in really since February of 2021, when the advanced decline line peaked on. It's also the same time that the ARC funds peaked. So it's been 2 years since growth has been out of favor. I mean, 2 solid years in the most devastating bear market that we've experienced since the great financial crisis. So we're just a couple of weeks off the bottom. You're seeing great leadership, and we think that get your pencils ready if you're not in. And we've been out most of the year. We've been out most of all last year, except dipping our toe in a couple of times. But we're as heavily invested now as we've been in 2 years.
Yeah. All right. Yeah. And so just looking at this chart, I wanted to point out back in September, October, we highlighted how distribution dominant the indexes were. You're definitely seeing a change here with these, bigger blue bars and more accumulation in these high volume days. So, a change of character, just another thing I think corroborating the start of the year. And yeah, just more again on the crossovers, we're looking at the 10-day, this green line above the 21-day, kind of our short-term trend indicator. Now, we're now all above, we're above the 50, the 200-day. So just, clear trend.
And back up, Wes, 1 second, one chart. And guys, for those of you that do look at charts, go back and look at the 200-day in the 2007 to 2009 bear market and the 2000 to 2002 bear market. And you can see there's the 200-day is still in a downtrend. You want the 200-day to turn in an uptrend. And I think you'll see that happen over the next couple of months. You can see the 200-day flattening out, and that will give you additional corroboration as well when the 200-day turns up. Mark Minervini has a trend template that he uses to identify his screening methodology in terms of him identifying stocks. And he's looking for the 200 stocks short term where they're above the 200-day for 1 month to 5 months. So the 200-day hasn't even turned up yet. So that's just going to corroborate how early we are in this cycle. So we think that the technicals are going to improve in the ensuing months, and we think you'll have great new leadership now moving forward, not the old leaders.
Okay, and we did touch on this earlier in the beginning of the year, the NASDAQ versus the 30-week average. Now we've closed 4 weeks above that 30-week average. So, the Stan Weinstein long-term trend now positive with that. Okay, and so looking at the percentage of stocks above the 50-day and the S&P 500, the last couple times that we saw this sort of 80-90% of stocks above the 50-day, it's kind of led to a sell-off, especially in August. We look at this peak, right, where it was kind of overbought. And like we talked about earlier too, like this overbought sort of not reading of 90% of stocks above the 50-day has so far held up exactly, how you want it to. When you look back at 2020, where you had 99% of stocks above the 50-day in May, right? And then, it just has to stay in this somewhere above 50% and so maybe, close to 80%, right? It's got to be in that range and to sustain to see a sustained positive uptrend. So, this has been, I think, pretty positive to see that that breadth kind of maintain in this range, right? That's a good sign. And then this is the S&P 500 and stocks above their 200-day moving averages. I think we noted the divergence here back in December. There's this making higher highs, right, while the index makes a lower high, and just more confirmation, and we see that again at the beginning of February, making a higher high, which is then confirming, right, the higher high in the indexes. Yeah, and we'll see a similar picture with the NASDAQ. The NASDAQ was the weaker index throughout the last year. So, but we are still seeing some of that, positive divergence, right? We have this percentage of stocks coming back and hitting that 75-80% level again, while the indexes have made this sort of lower high. But I think when you look on the longer term basis, the NASDAQ versus the 200-day moving average, a clearer sign that we have some positive divergence there too. We're just seeing the underlying stocks, get above their 200-day, and a lot of these stocks that I think we're going to look at this evening are going to be ones that are kind of early, right? It's somewhat of a divergence because there's been such a bloodbath, but we're looking at some of these stocks that are sort of in bottoming bases, and are popping above their 200-day moving averages and heavy volume. So there's a lot of accumulation and just this really early turn in trend for a lot of the stocks. Interesting. We have So I don't know. I didn't know anyone could do that. Let me get rid of that.
If you
And I think, oh, it's gone. All right. Okay. And so again, another thing we've been looking at for as far as breadth is the new high list. A real good pickup in new highs in early February. And then, finally highs outpacing lows for some period of time, actually. And so, underneath the surface, we're seeing just, more breadth, right? There's more stocks participating in this up move. Really encouraging, right? We thought we saw that improvement for a very brief time, very small number of net new highs back in August. But we've got a higher number of net new highs here, and it's lasted for almost 2 months now, this period of highs outpacing lows.
And let me point out as well that, guys, in a rip snoring bull market, we're just seeing the early beginnings here. You're going to see 500, 600, 700 new highs to new lows. When you know that you're in just a rip snoring bull market, this is just the beginning. And that's what you see. You can see back there in right there to that period in 2021, you can have, 4, 5, 600. And so you're going to have many, many stocks to choose from, moving forward. The key then will be to identify which ones to buy, because you'll have so many to choose from, and, everything will work, and you'll just have to, have your tactics in place so that you get the proper feedback, so that you do buy those leaders and you don't get stuck in the stocks that are underperforming while the bull market is really establishing itself.
Yep. And okay, looking at the McClellan oscillator versus S&P 500. This is the oscillator showing us that we were overbought sort of in that early January period. And then we kept making, more headway, and we were oversold. And so, at this point, I guess it's kind of a neutral reading, but, bouncing off this oversold level that occurred just maybe a day or two ago, it is good, right? We're just seeing more supportive action when things are bouncing when we expect them to, right? And just one of our kind of, I guess, preferred oscillators. Okay, and so the VIX is sort of, it looks like it's been in a downtrend since October, and has not been able to pick up, right? It's kind of lived below this 50-day moving average for some time, and these spikes are quickly have been sold off, and closed at the lows the last several days here. And so, we really want this to stay below 20. We see it breaking, to new lows following the December low of the VIX. And it's again, we see this just positive action in stocks, lower volatility. You're not getting kicked out of everything, and this can continue to creep lower and support the bull market. And so here's just another longer term look. Interesting about how in 2020 you just see this downtrend of volatility through 2021, and hopefully this is the beginning of that. Also, I would say that that volatility is trending downward ever since October, and this is exactly what you want to see in the bull market. It's just going to continue to hopefully have things quiet down. And we didn't get that real spike, right? We talked about the spike. Everyone wanted capitulation, the spike in the VIX and all that. We didn't get the VIX spike, but we did get we did get a pretty big spike in the put call ratio, which is interesting because it did coincide pretty closely with the absolute bottom of the NASDAQ, I guess 6 weeks ago. But we'll take a look at that. Carl, and thank you for pointing that out. I don't, that's one of the things that Hedge Eye has harped on, the 0 day to expiration volume that's not captured in VIX. I don't really know how to, I don't know how to even consider that here, right? But yeah, that, I mean, I from what we've heard that that's a big component of option buying in recently.
It also shows you can't, if you wait until everything aligns, you'll never move. You'll never make a decision. And we've never looked at the 0 days to expiration in 35 years. So I don't think it's anything that we're really necessarily following to move us from one side of the fence to the other side of the fence. The market action is dictating that we're moving from a defensive posture to a more aggressive posture here. And just with the setups that we believe that we're starting to get traction in, that we're seeing. And that's the number one criteria that's really worked, for me over 3 decades. Go ahead, Wes.
Mm-hmm. Okay, and so another chart, we look at the active manager exposure. Down here is a survey of active managers and how long they are. That long exposure has hit 85%. That's the the highest in a year. So it's not, I don't think it's necessarily overbought, but if anything, you can see important lows are some key things to watch, where these get, that was maybe 10%, and that was maybe less than 10% in March of 2020. So since then, active managers coming off the sidelines and participating in this rally more so than they have throughout all the rallies in 2020. So there's clearly just been this growing appetite for risk and willingness to get invested. This is the bulls versus the bears, the AAII bull bear sentiment survey. So for the first time, and also very long time, maybe a year, we have bulls outpacing the bears. It's not an overwhelming number of bulls. It is kind of a low number of bears, but not a timing tool, but it's interesting. We've had this persistent, really persistent bear market, and so obviously bearishness outweighed bullishness for quite some time, and so we finally have that sentiment flip, which you're supposed to use this as a contra indicator, right? But again, not a timing tool, and it's the first week we've seen this in many weeks.
Wes, back up one slide.
Mm-hmm. Oh,
and guys, if we're in a new market, if we're in a new bull market, we're certainly in a new uptrend. You can clearly see we're in a new uptrend. It's nascent, it's the beginning, but look how far from the 2020 bottom to the top in 2022. Look how far we moved. And again, true market leaders serve to move. They typically move 8 quarters, 104 weeks. And we're so early in this. And so now we should see tons and tons of new leadership and stocks making new highs, in the next, a few weeks. So you can just see this, just the duration of the move here, and how the bear market has been so brutal, and now we're just turning the corner. You really don't want to be in the indexes here. You want to be in the stocks that have true alpha, that you can get these stocks that go up 2 to 3 fold. And we're just using the S&P and as a placeholder at the moment till we fill out the investment portfolios. But you should see more and more new stocks that emerge soon over the next earnings quarter.
Yep. Okay, here's the put call ratio. That measure of sentiment, like I mentioned, just that spike at the end of December, really coinciding nicely with the NASDAQ bottom, ultimate NASDAQ bottom. I mean, I remember just, I remember thinking, okay, I guess it's just people afraid to, wanted to sleep at night on Christmas Eve, but, it was this was very well timed, apparently. So, that's why we watch it. And then the equity put call ratio, same thing, huge spike. I thought this was interesting too. And, I don't understand the options markets completely. I thought this was very odd. Like, why is this? I don't know why that would spike more in December of 2022 than it would in March of 2020 when there's a pandemic. But, we saw that spike and obviously coming back down from there. Something we continue to monitor, high yield spreads. We're going to keep looking at this just because, who knows if there's danger in the economy. Maybe the recession, we're all just early with the recession fears, right? Maybe it happens in December of this year or something. And but this is something you just have to monitor, see what see if credit is going to sniff out any kind of worrisome developments prior to the equity market. So we'll keep looking at that. But it peaked in July and has just continued to make lower highs, which is showing that there's not a whole lot of or there's not maybe as much risk to defaults as people had anticipated.
Hey Wesley, if you
Yeah.
go back to the previous chart, if you correlate this with unemployment rate, you will see going back 2000 and 2008 that when this goes higher and unemployment rate goes higher, that is very bad for the markets.
Okay, yeah, excellent. All right, and that's so we obviously have to keep this in mind, because don't have just tunnel vision. The bond markets can sometimes give you, obviously add some information here. So excellent.
And I'll pitch in as well.
Okay.
Yogesh, thank you so much for that comment. It seems unusual that we've got an all-time low in unemployment at 3.7%, and the Feds said that they're watching employment, the jobs number. We had 500,000 new jobs last Friday when the estimate was 117,000, I believe. And it seems unusual that the Fed, they're not going to be cutting rates. The Fed futures models show that. So, John Teed and I were talking about this the other day, and we had that on our slide that we could be in this 1994 to 1995 cycle where you just pause. So it's going to take two more Fed meetings before they pause. And they're not going to cut probably until 2024 at some point. So that's not why the market's moving up. The market's moving up just because of the momentum. If people want to be in, people want to be in, stocks are acting better despite this macroeconomic headwind that we think that's out there, which is the Fed keeping rates higher for longer. For whatever reason, the market is discounting that and concentrating on, and so we're concentrated on the stocks, not the narrative here.
Okay, I wanted to show this ratio, growth versus value, just to to kind of put in perspective, right, how growth has been so out of favor for the last 14 months or so from that November peak in 2021. And this could, if this is going to be the start, hopefully risk on growth starts outperforming value again. You get more high flying leadership stocks that in the tech area, right, in the growthy areas. And so you look back at 2020 and you just see how much that did outperform. We're just we're 4 weeks off of that breadth indicator.
This is let me pitch in, Wes, excuse me. I think I might take this chart and post it on my wall. This shows you, this is risk off versus risk on. And you can also look at to see the devastation, for example, in ARC. That's risk on. You can look at the FFTY, which is the IBD 50. You can also look at the IPO Renaissance Fund to show what's happening in the IPO market. But this truly is CanSlam growth investing. This is what's going on in the last year and a half to 2 years. And if we're right, this is like a golden opportunity, and we think we are right. So we'll the time will tell.
Okay, yeah. Joseph. Yeah, I added this back in Bitcoin. Here it is, coming back. I thought it was funny. I know we did take it out of the January presentation, probably like right here. Of course, you take it off your radar, and as soon as you do that, you kind of capitulate and it's off to the races. So put it back in the presentation for this month as it just continues to assert itself. And really, I think another risk on type of indicator, right? It's this very, very early technology that has so many doubters and everything. And so, risk appetite's increasing here, and I think interesting. I mean, that's an important move. A lot of accumulation here in to start the year, and that's powerful. That's a powerful move. Okay, and the market is going to be fighting this still, we think. So you have to continue to watch rates. I mean, if rates do just keep going higher and higher, which I think happens from persistent inflation, right? That's probably what really drives rates higher. That is something that this is what the market had to contend with the entire or most of 2022. Rates creeping up, and that risk reward relationship gets very distorted, right? As treasury rates get this much higher, and so you have to I guess funds rebalance and shift more to treasuries to take advantage of that. And this is something you have to be aware of. The long end of the curve too, picking up a little bit more recently since the Fed meeting. Up from 3.3% to 3.8%. That's serious, but the market again shrugging it off, which is even better. But you worry, you just look at this as if it's a stock, I guess, and say, okay, is it in an uptrend? Is it just making is it making a lower high here? Is it going to turn? Is it going to reverse? And if it reverses, great, great for stocks. If it doesn't, and if we recheck the high and go to 4.3%, that might be something that the market has to deal with, and that might cause some digestion, right? Hopefully, with the breadth and everything we're seeing, all this positive action, it can withstand that, and we'll see stocks hold up. But keep an eye on rates. I think they're still going to be important. So there they are. And then the 30-year really saying the same thing. And then, okay, just a couple more here. We'll look at the yield curve, which we all know by now has inverted. It's been inverted. It's still deeply inverted. Signaling that we should see a recession in the future. It might be early. Part of this inversion is due to inflation slowing. Part of it is probably due to growth slowing expectations as well. But it obviously has not been a good timing mechanism still, but this is what we have to, just in the back of our mind, we have this information. The yield curve's inverted. It's telling us something. The market is still telling us other, something else in equities, but historically, just a super inverted curve. Oh, and that should say junk, but this is the junk bond. Just wanted to point this out too. The junk bond index, more risk on, right? This is this has changed to an uptrend, right? It looks just with this break higher. The general rate environment has pulled this in, but before that, right, we have just clear signs of risk on appetite here. The 10-day above the 21-day, above the 50, above the 200-day, all that. And something we monitored a lot in 2022. Lastly, was the dollar. This was also a lot of the story of the bear market through October, right? It looks like the dollar peaked when equities bottomed. And so, you know, that inverse correlation was super strong. I don't know if the correlation has been quite as strong, you know, of late, just because the markets rallied, while the dollar has also rallied, right, the last few weeks. But you know, any breakdown in the dollar, you would think if that, you know, that relationship is going to hold, then that's positive for equities, positive for earnings, maybe not positive for inflation, but you know, it was such an important, I think, part of the narrative in 2022. We'll continue to take a look at this. And really, that's it. We can move on to stocks.
Thank you, Wes. Let me just adjust my screen here.
Roy, I gotta tell you, it feels really nice to hear you optimistic and positive.
Yes.
Because for the past like year and a half, since November, you were completely bearish. You were bearish before everyone else. So hearing you positive, finally thinking that we've hit a bottom, it feels really good. I appreciate all your help.
Thank you so much. We haven't wanted to be bearish, but you know, we didn't have any good positive news. Now we're getting the feedback and we're seeing it. So we're excited. Joseph, you like the market now, don't you?
Oh yeah, I think we're getting close to. I mean, I think the low's in. I think we're in a new bull, just based on all the breadth reading and stuff. I think something catastrophic would have to happen for us to roll over back to the lows. I just, unless that happens, I don't see it happening. So,
You know, the market typically bottoms before the recession hits. You know, the market bottoms into the recession. And this time the market's bottomed and we haven't been in a recession yet officially. So it's very odd, very unusual, but we're just seeing the setups now. So we're seeing the setups. We know what it looks like from 2000 to 2002, 2003. I lived through that. I know it took about 3 or 4 months before the leadership really exerted itself. And we're seeing that now. John Teague, what's your view in the market here? What are you doing?
John, can you hear us?
John, can you hear us? I wanted to get your John.
I see him.
He's tied up. So listen, guys, let's take a 5-minute break. We'll come back and then we'll hit what we think are the salient points and the stocks that you should be focusing on right now. So let's come back and take a break and come back in 5 minutes.
Roy, you didn't get CRDO, did you?
I had a little bit.
Oh, really? Oh, wow. Oh.
Yeah.
You know, I just never, I just could never get an entry that I wanted it. I just couldn't get in. Like, I couldn't find an entry for myself. So I just let it go. And I guess I got lucky that I didn't get in.
Oh, we didn't own it for clients because it was just too speculative, but I owned enough to get Credo, get knocked out.
Yeah.
Just don't get home and say, "Honey, I ain't got the food."
Oh, I had a great entry getting in, not so good of an entry getting out. I got out of it post market. Well, I guess that was yesterday. I got out
What'd you get out yesterday or today?
yesterday after market.
Okay, because I got out this morning. I was wondering how you sell that after market.
That through Fidelity, many you can
Okay.
pretty much trade aftermarket with all the firms out there, but a lot of people got hit with that stock. It was showing such great resiliency. It looked great on the monthly, and it was just breaking out of a 2-year base, and lower quality. They lost a customer cut back, and that was the implication. Small company.
Yeah, I think, Roy, the customer is Microsoft.
Yeah, Microsoft. And that, guys, I tweeted a little bit about it because there were a lot of tweets on the stock. And that shows you how important it is for position sizing. And CanSlim, CanSlim, the concept in itself, O'Neill would routinely have 20% of his money in one stock. And in a rip snoring bull market, that's fine. And many times my max position is 10 to 20% of my personal account into one stock. But for us managing client money, we're using 5%. But a 5% allocation and down 50%. That's the biggest hit I've ever taken in one stock ever in 35 years. And I was fortunate enough to only have a 5% position personally.
Yeah, so after once this bear market started, I started doing only 10% instead of the 20. So even then I was in full position in CRDO because I kept adding up, was closing, was showing trend. The only saving grace is, I had position sizing, but it still took, I took a pretty good hit. That's okay. Recovering today. Were anyone of you, Roy, were you in CPRX as well?
Yes, I was. Yep.
Yeah, that's good. Yeah, in the span of 1 month, 2 hits.
Yeah, and actually, I was talking to Wes. I grew up in a small country town in Louisiana. Welcome, Bill Ritchie. I see he's on the call, and he can relate to this. And we used to watch the farmers in the pig farms. And I told Wesley today we're going to implement pigs in a trough strategy. And if you ever have been at a pig farm and you see pigs, you only have a certain amount of pigs that can eat out of the trough. And what we're doing is we're getting the best pigs, and we're keeping them until we push one out, till we get a better looking stock and a better looking setup. But we want to have 5 to 10% in a position, and we're putting on more positions, smaller size, working up to 5%. We're not going to do that quickly in terms of bringing everything up to 5%, but we're going to add to the positions when we can push some of the pigs out of the trough. So I think that's the best strategy that you can implement today, because you can't kiss all the babies, but you want to kiss as many as possible until you find out the babies that you want to keep.
Hey, Roy, what percentage are you invested currently, if you don't mind? I
am 80%.
Okay.
I'm
Roy,
80%.
And has that been that way for a couple of weeks, or is that, did you
So
just get up to 80?
I got up to 80, 90 in the last five to 10 days.
Okay, because I'm only asking because I watch the market, and I haven't been that much invested in, even like the small investments I've made in my positions, I've gotten kind of kicked out with like small losses. So I kind of feel like I'm missing something.
No, we've had many stocks where we've had
Okay.
1 to 2% positions, and we've gotten kicked out with 8% losses, and we've just taken them. Like, we actually had a stock that reports tomorrow, Iridium, that we kicked out with about a 5.5% loss
Okay.
in it because we didn't want to carry it into the number. And but so we've had quite a few of those. Only in the last 2 weeks have we really seen some leadership. And with that being said, what we're going to do is we're going to show, and remember, these aren't investment recommendations. We're just sharing with you what we think are some of the best setups in the market currently. You can take a screenshot. This is what we currently own. And then we're going to also show you our focus list where we have about 30 items. And we think that these are leaders, potential leaders as well. So let's just go through these, and then we'll take your questions, and we'll look at stocks that you guys want to be that are interested in as well. But we want to identify what we think are the leaders in the market. Starting with the number one institutional stock in the market, you can see the volume. That's Airbnb that reported today. And we took a small position in the stock today. We're looking to buy it coming in tomorrow, a couple of points, and then taking out the high. We want to press it. And you can see the institution volume on, this was a 10-300, so it's up 10% in price on volume of up 421%. These typically, when you have momentum like this, these typically are the beginning phases of a big move. So something's changed. The stock's been in a downtrend forever, and now the institutions are buying it based on their earnings report. You can see earnings were up 500% and revenues were up 24%. And this is an IPO, and we think that it's going to perform. This is called an early, a late bloomer, according to the life cycle people. And so the stock's been in this downtrend, due diligence downtrend for 2 years, and now it's just turning up. So you can see it's got a great price, $137. If this stock beats and guides up, you're going to see it over the next year exceed the 52-week high. And this is early. And that's when you reach this turbulence zone, that's when the institutions are going to really make up their mind in terms of selling their position or adding to their position. But when stocks that go through a 2-year base like this, they typically double. So that's, $225. So I could see this stock being $450, in the next 2 years. So this is one of our top picks. Everyone knows who Airbnb is. You've had good reports in the hotel industry, from Hyatt to Hilton, and we think that we think there's a potential. This is a leading stock that the institutions are piling in, and you can see that you have a number of A+ rated funds. There's Fidelity, Contra. This is where the big boys are going, and it's got great liquidity. This is something that we'd like to have a 5% position. Can certainly have a 10% position if it gives us an opportunity to set up. The next stop is Impinj, and this is a company that specializes in radio frequency devices. You can see that you've got A+ mutual funds in in the stock. They just reported a stellar quarter where earnings were up 156%. Revenues were up 46%. And you look at the last quarter, earnings were up 950%. And you've got easy comparisons as well moving forward. You can see 41 this quarter that will be compared next quarter is 9 cents. So you're going to have a huge increase in terms of earnings and probably acceleration in revenues. One of the things that I look at that I've studied over the years is if you have stocks that accelerate, if they accelerate for 3 consecutive quarters in earnings per share growth and revenue growth, those are typically some of your big winning stocks. You can see the estimates are for 63% this year, 32% next year. We never look at PEs. So O'Neill never once ever considered PEs. If you're a value investor, you would have never bought Google, you would have never bought Tesla, you would have never bought any of the Amazon and so forth. So the great winning stocks don't typically come from banks or consumer non-durables or things like that. They don't have the horsepower that's necessary to propel your investment portfolio to record levels, in a quick period of time. So this has got a lot of attributes that you're looking for. It's the 37th rated group. It's important to try to focus on the top 40 industry groups. That's where you're going to get the leadership from. And this stock is just marking time with the 98 relative strength and a composite rating of 98 over here. So that's a great looking stock. One of our favorite stocks is this company that we just bought 5 or 6 days ago on the earnings report. You can see it's got a relative strength of 95. They came out with a 200% earnings report, great revenue report. And this is a company that provides the solution that you put in your ear for sleep apnea. I don't know if it's in your ear or if it's implanted in your neck, but it's a solution for all those people that have sleep apnea that are wearing the mask and that they have to tote that around. And this is being embraced. New technology, new medical device with great earnings. And remember CanSlim by itself. You're looking for 25% earnings growth and 25% revenue growth, but the true big stocks, they have triple-digit revenues, many times triple-digit earnings growth, and that's where you get the stocks that can double. And so all the stocks that we see, we don't know who's going to double, but we've got, we're on the alert for these types of setups. So we're not buying the stocks, many of the stocks that are beaten down. We're buying a couple of interesting turnaround situations, but you want to focus. You don't want to be in Microsoft or Apple or those stocks here. You want the stocks that can double from here. And those are good. Those are going to be the stocks making new highs in price. So you've got institutional ownership, all the top funds are in there. So, you've got buy recommendations. Those are the guys that move the needle and move the stock. Uber is a new buy for us. And we're trying to get up to 3% positions right now, taking them up to 5 just when we get, when we get a secondary buy opportunity. So Uber, which was one of those IPOs that busted because they weren't making money, and it's gone sideways for 4 years. Something has changed in the last 2 months. This is the last 2 months. You've broken this downtrend technically this month, and game on now. So you had institutions are piling in right now. You've got 1,800 mutual funds that own this. So, you know, O'Neill used to say, this is not your Aunt Susie buying. This is huge institutional buying. There's the weekly. Look at the setup on the weekly, just breaking the pivot. And of course, if you look at the daily, you can see there's the powerful earnings move where the stock was up 10, looks like 10%. Looks like 5% there on big volume. And then you had this normal retracement on the pullback to the 21-day. So there's your support area. And we added on that pullback right there. And, you know, look at the stock. And the reason the stock moved up is because they went cash flow positive. They had a profitable quarter. They smashed their earnings estimates. They've got great leadership. And, you know, this is a ubiquitous company that's got, I think this company is the biggest employer in the world, I think, and across the world. And the stock is moving up. Institutions are piling in because of the quarter and guidance that the company gave. So, you know, this is a stock that's 36, and we're looking for all these companies to go to new highs over the next year or two. So it's just launched its move out. And so you have quite a ways to go. You know, if we get to new highs, you'll have a double there. And then these stocks that have been, it will have been basing for 5 years. A breakout of that base right there is going to signify the move from the top to the bottom, and you reverse that and project that up. And that suggests about $120, $150 stock. So there's Uber, institutional favorite.
Right.
Yes.
For Uber, would you not consider the overhead resistance that it has to overcome to go to all-time high?
Yeah, you know, that's a great question. We have a couple of these, and you know, remember when Facebook took off, when it launched, it had much overhead resistance when it took off after the bear market. Actually, if you go back and you look at the 2020 bear market, at the bottom, Tesla was at the 200-day with 50% overhead. You had Shopify was below the 200-day, and it had a marvelous move. You know, a stock went up many-fold from below the 200-day with a lot of overhead. I'll share something with you, that a recent statistic that I recently saw. In terms of leading stocks, if you study the leading stocks over the past 30 years, and you're making a transition out of a bear market to a bull market, about 28% of the new market leaders are within 25% of their 52-week high. So you've got about 25-30% are within 25% of their 52-week high. And then you do have stocks that are down. You do have some stocks that turn into the next market leaders that are down 30, 40, 50%. That does happen. The way that Tesla was down in the 2020 bottom, that turned into a big winner over the subsequent 2 years. So you just have to keep that in mind, but you know, you definitely keep that in mind. And guys, what I'll show you, I'm getting around. This is what I'm looking for. This was a big stock. This is coming out of the 2020 bear market. So CrowdStrike was on my watch list. It was a hot IPO that undercut the IPO price because of the bear market. started to turn up, and then you had the last week or so, the last 10 days of the bear market, and the stock spiked down and reversed up. So the stock got down to, when it broke this downtrend line at 80. So this stock went up from 80 to 300, and you had the overhead. The old high looks like it was 100 all the way down to 40. So you had that type of overhead, and it turned into a brand new leading stock over the next couple of years. So you can get a couple of these IPOs that have overhead, and but if they haven't made a 52-week high in a year, most of the selling is out of it. Most of the selling is it's insignificant. And so I'm seeing some of these stocks that I think have the potential to be the new leaders, and they're not going to be stocks that you've heard about. It's not going to be Disney. It's not going to be Netflix. It's going to be stocks that performed like this, the way CrowdStrike did. So we're trying to identify those. This is a stock that is one of the widely held technology stocks in the industry, Snowflake. And of course, software companies have been out of favor, but we think that there's a new move that's just transpired, and it's on this stock. As the stock moves through the 200-day moving average, and we bought this stock 3 days ago, 2 or 3 days ago, and you're seeing the early turn where the 10 days crossing the 21 days above the 50, and you can see the stock moved higher, and then the stock pulled back to support. And when the stock takes out this area right there, you can press it. And this is owned by 1,600 mutual funds. So you've got Wall Street in it. The stock's got a lot of overhead, but this is how some of these IPOs like CrowdStrike turned. See, this looks very similar with this, with this bottoming base. And it's okay to try some of these. But just the caveat is, yes, it does have overhead, but you've got Wall Street in there. It's turning, and we think that this is, they've got a great business model, great product, great revenue growth, and the CEO has stated that they're going to be the fastest company that grows to 10 billion in revenues of any software company, and they're utilized by everyone. I don't know the exact statistic, but probably 90% of the Fortune 500 companies are using the stock, and it's been beaten up. Now it's turning, and that's okay. It's okay to take a few of these. We view the fundamentals in a company like this much better than a Zoom or a Teladoc or those stocks that have been beaten up. We think that this company is a gargantuan company in the business. Okay, next stock would be Melly. Mercado Libre. And what we like about this company are the numbers. Look at the earnings growth last year, 427%. They're accelerating this year from $8.80 to $14.73. It's a $58 billion company. And look at the growth that this mammoth company is doing. $1.30, $2.40, $2.56. You can see the acceleration. You get a company, guys, that's accelerating.
Right.
If you have a company that's accelerating their earnings and growth prospects during the past year, then you've got something. Look at it's got a 91 relative strength. And I think we just initiated. Wes, when did we initiate this?
I think it was 3 days ago.
Okay, so we added the 21 day a couple of days ago. Earnings are going to be in the 22nd. So we were talking about adding to it today, taking out yesterday's high. but we just want to just sit on our position. We've got a 2.5% position, and we'll probably wait to see if it takes that 1250 out on earnings. And there we'll probably go to a 5% position. So all these positions that we have, we want to take them up to 5 if they act correctly. Notice you've got 2,300 mutual funds. Wall Street's all over it. This is where the liquid leaders are coming from, and you're going to see this. You know, companies like this have a tremendous liquidity, and you know, and they're just buying a hand over fist. And you can see that down below as all these companies are increasing their exposure over the last 3 or 4 quarters. So it's setting up. It's above the 200-day. It's in one of these stage 2 uptrends, and this is a common, you know, Stan Weinstein setup from his book. I think it was Secrets. I forget what the title of his book was, but this is a stage 2 uptrend that's pulled back. It's the perfect buy, and now we'll see if it'll hold. So you've got it's represented by having tremendous earnings growth and revenue growth. So a company like this, you can see it go through 1250 presumably, and the next move takes it to 1500. And so don't think about the price of the stock. Think about, you know, a shortcut way of looking at this is just say, hey, move some decimals around. And, you know, would you buy an $11 stock that goes to 1250 if it can go to 1500? And so think about, I mean, that's up 40%. And you're going to see this quickly with the good earnings report. You know, you're going to see this move. And you can see there's the bottom in January. So you've had, you know, the move off the bottom, and then the consolidation, and then the move up. That's where you would add to the position. On holding, they've got a terrific shoe line that's very popular. Roger Federer is a spokesperson, probably got some ownership in the company as well. It's quite fashionable. It's an IPO, and it's one of these. If you study the life cycle trade by Kathy Donnelly, E. Bobbitt, and Eric, and those guys, and you study those setups, this is one of those setups. It's a late bloomer that's just turning, just like the CrowdStrike trade. So you have a number of these setups, and they're going to have to report good earnings for them to maintain the uptrend. But this is, we've got high hopes that we've got something that's that the consumer is really enjoying. And you can see that they've got tremendous revenue growth, 42%, 61%, 72%, 49%, great revenue growth. And they have an easy quarter that they're going to be compared to. And by the way, we saw retail sales that was reported that was terrific today, which is probably one of the reasons that interest rates rose a little bit, because the consumer shows that they're still steadily buying. So this new company, but you want to see these A+ funds over here at the right in the stock. And anytime you see the A+ funds in the stock, that's giving you there's your research and giving you corroboration. Look at how this is just turning off the bottom, and you're going to see if this turns into the real thing, you're going to see these stocks make new highs, you know, over the next year or two. I mean, these are going to be the leaders. And so every stock that we're looking at, it's got the potential to double. So, you know, that's why you want to be in these individual names for alpha. And you don't want to be in the S&P. You want to get out of the S&P. And again, we have 15% in the S&P right now for placeholders, but we're going to be moving, and, you know, we want to have a concentrated portfolio and find the best pigs in the trough. And and get those, because we think that we think it's going to be a big year finally, as the market has turned, and we're seeing these turns right off the bottom. We added a small position in Dexcom today. Many of you are maybe aware of this company. They've got a continuous glucose monitoring system. I think they were actually, Wes told me they were on the Super Bowl, I think, or I'm not exactly sure. But
Joe bro.
Who?
A Jonas brother was on there talking it up, the new, whatever their latest iteration.
Okay. So, the latest, we know how big of a problem in our country diabetes is. This is easily understandable. They just got Medicare approval for type 1 and type 2 diabetes. They've got the standard in the business, in the industry. And there's the break of the down trend line 1, 2, 3, 4 days ago. And we took a 1% position in the stock today. We're going to try to, if the market pulls in and the stock, comes in a little bit, we think this is going to be a big seller. And a number of firms have it as their top pick for 2023. And we're going to, if we take it when, we have a buy stop to add to it, taking out that high. If I can get my cursor to work. Right there. So you want to press it. It's setting up, not giving anything back. And that's what you're going to want to see, guys. So say the indexes are down 100, 100, 200, 300 points or something like this. You want to see your stop just hang in here and not collapse. And that's, this is, and really that would be quite welcome if the market indices sell off and you have a pullback in Microsoft and Tesla and those names, and these stocks don't give up anything, like Airbnb that just reported today, Trade Desk that reported today, Dexcom that reported 3 days ago. And look at the institutional ownership. So this is the cream of the cream. And, it's a great price. That's $120. And look at it on the weekly. This is just a great congestion right here on the weekly. And how you want to, this is, you can see clearly here, we've got an alert, press the position. So you add some there, and then you add more, taking out the trend line that's right there. See right there, guys, that it's above it. You want to be averaging up. So, you buy a little bit here, buy a little bit, taking out this weekly high, and have your position on taking that pivot out, which looks like it's about 120. What's that? That's 130. So you want to average up. That's what you're interested in doing. And so look at that. There's that on the weekly. And the daily numbers are expected to accelerate. Look at the earnings report. Earnings were up 900%. Minimums 25%. Revenue growth 17, 18. Big, nice company. $46 billion market cap. So it's in the sweet spot where you want to have all these institutions that are buying, all these institutions. So you've got sponsorship. Big institutions move big stocks. So, and you want to see these stocks. This is the quality, the $100 stocks, the stocks that are over $100, that are 80, 90, $100. That's where, you can buy those easily with, from a liquidity standpoint. And that's, that's where the big winners come from. Remember Google when it came public I think at 80 and it broke out at 100. and it went to 500, $100 stocks go to 200, 200 stocks, $200 stocks go to 300 and so forth. That's how you get an Amazon and stay on an Amazon and a Google and so forth, and a Netflix and so forth. Shift for Payments, they've got a very dynamic product mix where they've got, they provide a payment system, full turnkey operation. They're involved in resorts, casinos, stadiums, and they've got the latest technology. And again, this happens to be one of those life cycle trades that we're talking about. See, if this is the big winner, it's been going up now 3 months, so it's showing itself. It's a $60 stock. There's the breakout at 100. So, we want to buy this stock all the way up, for a $100 stock that goes to $200 over the next 2 years. And there it is on the weekly. So you've had this long congestion. Now it's in this nice uptrend. And so, look, it was an IPO back over 2 years ago. So, it's gone through this due diligence phase. This has gone through this due diligence phase for, a year and a half. Now it's come out of this congestion, starting to move up. It's got great numbers. Look at the earnings. Earnings were 187%. They're going to be reporting a meekly 47% in 2023. You've got the right institutions in the stock, and you can see that it's in a stage 2 uptrend. And earnings are in 13 days. We've got a 2% or 3% position here. And we would be buying this stock right now, but I don't think we're going to take a higher. We might go to 2.5%, but it should be bought, taking out the 69.36. We just bought the stock 3 days ago, I believe. Wes, did we own this stock? We owned it earlier and got kicked out. We got kicked out in November, way back here.
Yeah.
Actually, we got kicked out that day, right there.
Yeah, that's probably it. That's right. Are you asking if we owned it prior to 4 days ago?
Yeah. I mean, did we?
Yeah, I think we bought it in January and bought a little more in the last few days.
Okay, so we probably bought a little bit, like right here, probably right there. I know I've got a lot of these wiggles here, and then added to it on this little pullback here. But 69.36. We want to have a 5% position right there with a good earnings report. We'll forget about the S&P. 3 more stocks that we'll look at here. Here's Mobileye spinoff. It's not a spinoff. Intel owns the majority of the company, and they took it private a few years ago. You're going to see Twitter do this, guys. So, Elon bought Twitter. It's private now. And you're going to see Twitter come back, and when they've got great organic growth, great numbers, and and when they can hype it up the way that they hype this Mobileye up, this is the strongest. This is the biggest offering that's taken place in the bear market, and you typically can't get any deals done, of course, in a bear market. Mobileye was the biggest deal that came out for the year in a bear market, so it's showing you that you've got institutional interest. The risk in the stock, and they make sensors for autonomous driving. And the biggest risk on the stock is the stock has moved up, and many companies like to raise more capital and do what's called a follow-on offering, and which typically makes a short-term peak in the stock. There's typically a little sell-off. And you've got also the lockup period ends in April, where institutions, excuse me, the insiders can sell a part of their stock that they bought, that they own from the IPO. But this is, this could be, this could be one of these huge true market leaders that has much upside from here. Look at the earnings growth. They did 125% last quarter, revenue growth of 59%. It's a $36 billion market stock. So, I mean, this is true institutional quality. We don't say you got 200 mutual funds in it. So you're going to see this increase over the next 90 days, I'm sure. And it broke out 2 days ago. So if this stock pulls back and holds here, and if the market digests, that's would be nice. So if the stock would just come sideways a little bit and give you another, just the way that it broke out here before, guys, you'd like for this stock to actually come in just a little bit and then take out this pivot.
You mentioned the follow on too, like AEHR, just as another example of what that looks like. What the follow on offering can do.
Right. There.
It can give you an opportunity to get in too, if it can go through that and price it quickly.
And this is, so they announced an offering, a market offering where they were going to sell how much, Wes?
It was $25 million. So like, I guess that's like 1 million shares or 750,000 shares or something.
And I actually bought this stock 3 days ago personally, guys. And of course, that's no endorsement or anything like that. But I bought the pullback here on the first day that it turned green, right there. But it's after getting credoed, it's such a small company where they're only doing 10 million, 14 million in sales. We can't buy this for clients, but it's, this has been a rocket ship since their earnings report. The earnings report's was terrific. And, maybe they're doing something that these other companies aren't doing, but you've got companies like Lattice Semiconductor, Lam Research, Applied Materials that are big in this area. But I think, what makes this company unique is they're sort of like ON, that semiconductor stock. They're focusing on a new generation of semiconductors that are in the EV space primarily, and that are in the automobile industry, which is a unique.
I actually own this one. I own this one from $25. I bought it through the WIC on the day after earnings.
Oh man, that's perfect. On this 10 after that 10-300 day, right, Joseph?
Yeah, so I bought it through the high following day at 25, and I still have a third of a position left in it. I'm just gonna let that ride.
That's a perfect. What Joseph just showed right there. It's how you buy. But you look at, but the market was still under pressure. But this stock was one of the first out the gate. And this is a perfect buy on the follow through. This is what you want to see with Airbnb. And this is what you want to see with Airbnb tomorrow. You want to see it.
That's actually my plan with Airbnb as well. I'm hoping for the same type of mojo with that.
Yeah, you bought an Airbnb today as well?
I didn't get it today, but I'm planning on tomorrow if I can get it through the WIC or.
Yeah. Yep. So that's really exemplifies a perfect buy. And we didn't buy it because we were couldn't believe the market as well. But this was one of the first stocks that took off. And let me see, I think I've got one more, two more. There's the IBD, the biotech industry index that we've got a small position here that we're planning on adding at 138.14. And it's just been basing for a couple of months. And this is this biotech index, when it turns up, it's so this is just early in the turn. We're hopeful that we get a move, something like that biotechs come and lead, and you have companies like Gilead and Biogen and Genzyme and all these companies, have big moves over for, there's a 4-year run. So we're just getting started potentially in biotechs, but we're not buying the biotechs that don't have numbers. We're buying the bigger cap biotechs. TMDX, we have a small position here. They've got a novel way of transporting organs through using warm blood instead of cold ice. That is being adopted all over the country, but a tiny company. And this is one that we might exit. There's nothing wrong with it, but we might exit. The earnings are in a week, but you do have great ownership and mutual, with mutual funds. When you get a company like this, it just depends on, like that Credo, how much are you willing to lose? If, say, what if something went down 50% like that Credo did? What kind of position should you have? How much are you willing to lose? And, companies like this could easily drop 20% on a bad report or something like that. So we're going to address it. We'd like to get the quarter out of the way, but you can see where I've got the trend line drawn. That's where you press it, guys. So you want to get the best of the best, and then you want to press them as they go through pivot points on the upside. And, and get it down. We'll find out, you could have, you could start with a couple of names and have bigger positions, or you can do what we're doing and have more names, because we don't know who really who's going to work or not until later. And then, we're going to narrow it down. And we've got two more. PDD this is a Chinese retailer this is more like a Chinese retailer like Walmart, and the stock is positioned itself on the 50-day. We thought we missed it. See where it broke out at 99. We had a little bit of stock envy right there when we didn't own the stock, but we just gave it a little bit of time, and we bought this at the 50-day over the last week or two, and taking out that pivot right there. Right there, if I can, we have an alert for a buy stop, taking out that pivot right there, which is yesterday's high. And so, you want to, if we're going, we'd like to have 5 to 10% at the end of the bull market and these leaders, but we're going to incrementally, as they show that they're holding and they go up, we're going to incrementally add on strength. And you can see a big Chinese company, 256% earnings growth. China's opening their market. It is quite controversial. China's quite controversial. Of course, they're in the news. They're stealing all of our technology. We've known this forever, but I'm just purely discounting that and looking at the action of the stock. And the stock is in an uptrend, so we're pressing it. We own this Silicon Laboratories. There's the earnings report. So you can see, of course, you can note how my tone is so much better, because we're getting these stocks that, okay, this is what leading stocks should look like in a new bull market. We haven't had any, and this is what they're looking like. And we had a few more, but that's what we totally own, what we're going to potentially buy. Of course, it's not, and do your own due diligence, invest your own risk. But I hope that we provided some stocks that you can do that we gave you some shortcuts. And you can take a screenshot here. This is our focus list. And this is what we're looking at adding on a pullback, or if the setup's right. So this is, I mean, that's the extent we've narrowed it down from thousands and thousands of stocks to, if they act right and the earnings are good, we're good. This is what we have on the table right now that we can potentially buy by the setup. And Trade Desk just reported today with that 10-300. But I think this will give you a great list of stocks to examine that can be these potential leading stocks that we're talking about. Some are IPOs like Dutch Brothers, new companies like AEH Systems. There's Toast. Las Vegas Sands is one that we want to add to on the setup. If it holds in here, it's at the 21-day. And, you know, they've got a big presence in Macau. They've got 3 casinos in Macau. And they actually were, what was that stat on West that you pointed out the other day about their earnings or EBITDA?
Oh, well, it must have been just the fact that they were running positive EBITDA despite being shut down in, like, you know, a majority of their properties.
Yeah, that's what it was.
Yeah.
That they had a positive EBITDA and they were shut down 91% of the time. So imagine as they're opening Chinese as a nation, they love to gamble. And so we think that, you know, there's the long runway there. And Wynn had a great report. And there's so you've got confirmation in the industries. And there's the Wynn report. And remember also, guys, most of the time, it doesn't matter what the earnings are. Necessarily, it matters how the stock responds to the number. So you can see sometimes people are baffled when they exceeded expectations, when the stock had a record quarter and the stock plummets. And you know, it's just how it's in the conference call. It's reading the research report closely that will give you the insight to, you know, whether or not buyers or sellers are going to emerge on the report. But what's most important is the action on the stock at the report.
Hey, Dad.
Yeah.
Someone asked, for one, someone asked to show the list again in full form, but someone asked about ACLS and how you get into that, because it's gotten away. ACLS and ALGM are like two that a lot of people probably have missed, or we missed. And how are we going to get into those leaders? Is it late? Is it too late? You know, or is it possible to just totally miss it, or what?
And Ashish asked us earlier before we got started that very same question. So here's the list, guys. There's Mexico. We like Mexico. EWW. There's that MNDY that broke out on the number. Global Foundries. Earnings were up 700% yesterday. And this stock was down because Warren Buffett sold Taiwan Semiconductor. And so it put some pressure on the stock. And we can see, you know, this stock has really good action with the great numbers, and their business is expected to bottom and trough in the second quarter. Okay, I'll show you this. We only have stock envy for 2 stocks. ALGM, that is the leading stock. Look at this beautiful trend line I drew. Man, I can draw a pretty trend line. I don't necessarily execute.
Yeah.
There's your perfect trend line, guys. See, there's the quarter. It broke out. Perfect trend line. And you know, we just, you know, a month ago this is the first stock out the gate. So you don't chase, and this is a lockout rally. In fact, this stock has gone up, looks like 15 out of 16 days. And David Ryan, who I met in 1988 and taught me a lot with Bill O'Neill. I met David Ryan and Bill O'Neill in 1988 at a seminar, and I became an advocate and an ardent learner, disciple, I guess, if you will, of the CanSlam process then, because David Ryan won the U.S. Investment Championship for 3 straight years with triple-digit returns. And I wanted to find out, well, how is this guy doing it? What is this guy doing? And so that's how I got introduced to CanSlam. Okay, so here's the trend line. You can only, this is a lockout rally where you have missed it and it never gives you an opportunity to get in, and it will give you an opportunity. But look at guys, look at this. This is what's so nice. Look, it's at a 52-week high. It's gone sideways for 3 years, and now it's breaking out. So you look at this, and just say that is, what's that level? That's a $30 stock. And so you're going to see this $30 stock probably go to 100 over the subsequent 8 quarters that are coming. So it's going to, now how you get in, you wait for 2 weeks tight to let me answer that question. So you let the stock come in for, it's going to come in for 2 weeks at some point, and it's not going to give you, and it can come back just to the 10-day right now, but you just need to see it put in a 2-week tight, and you start adding a little bit on, when the stock pulls back. And it could be, guys, what could happen as well, there could be a downgrade where it jerks down in 1 or 2 days and people are going to be buying it. See, the institutions are all over it. And this is we want to be in this stock. We'd love to have a 10% position in this stock based on this action. So there's the breakout where I drew that lovely trend line at 40. And it's only up 10%. So it's up 10% of a stock that we think is going to double. So, and in the scope of things, you haven't missed anything. We haven't missed anything. If we get in this stock at $50 and it goes to 200, you haven't missed anything. We're just waiting for the proper setup, and it's extended here. So I doubt the stock will correct to the 21-day. I doubt it, unless the market really comes apart. I doubt that it corrects. Anything can happen, but I doubt it corrects to the 21-day. But we, just as everyone else, we're very aware of this, and you want to buy it. And the other one, same strategy on ACLS. See, these, you don't want to own Intel. This is what you want to own. You don't, you potentially, you could look at AMD, NVIDIA's, had this move off the bottom, but this is where the leadership is. We just didn't believe the market, this broke out before the power trend. We just didn't believe the market until later. And that, we were watching it, but it never, it never came back to the 21-day, the magenta line. So, this is definitely, these are the 2 leaders in the market. These are the stocks, when you go back and you look, when NVIDIA made its major move, when it went up many-fold, it showed up in the IBD 50. So this is in the IBD 50, and definitely leadership. Okay, with that, guys, I will, and let me just mention to you that, it's 9:12. We're going to stay on. This gives us a great opportunity to just exchange views, share our thoughts, learn more from you guys. So we're going to stay on tonight, probably another hour, and answer any questions that you have, go through any stocks that you're looking at. But this, I guess right here, this concludes our formal remarks, and we'll throw the floor open to you guys to look at any stocks you want to look at, or share any comments about what you see in the market, or what do you think in the market, and share your view. So with that, the floor is open. And thank you guys for attending tonight.
Roy, in building your portfolio, do you have any rules around industry concentration?
What I have learned is, and that's Carl. What I've learned is that if it's okay to have a concentrated position in one industry group, but you just have to be careful because they all seem to correct at the same time as a pack. So, like for example, when the market peaked, all the crowd stock peaked in February of 2021. And so they typically, they typically peak at the same time. So, if you look, for example, at the Market Smith Growth 250 and look at that leadership, then you can see, these stocks run in, the oil and gas field services like Schlumberger and Tidewater are going to peak at the same time. United Rentals and Will Scott Mobile are probably going to peak at the same time. They typically peak. So if you have more than one, there's typically two leaders in the industry group. So I would keep it if you're going to have, like, the solar group was leading before. The two leaders were First Solar and Enphase. And so and they peaked pretty much at the same time. Solar Edge, Enphase, and First Solar. And so, this Las Vegas Sands and Wynn Resorts, you don't need to buy both of them. You just need to pick one. So that would be, I would suggest that you only own one. If you have two leaders here that Market Smith Growth 250 is profiling with the best fundamentals in the group, you don't necessarily have to buy both. This is, it's like buying gasoline. I view it as a commodity, but the industry, but I wouldn't typically have more than two in an industry group.
Right. Okay. Thank you.
You're welcome.
Hey, Roy.
Yes.
This is Tom. Hey,
Hi, Tom.
Hey, can you speak to your strategies on, your position sizing and averaging up? You talk about getting in at 1%, working up to 5 and 10. Can you speak to your particular strategies just so maybe we can pick something up from you on that? Yeah,
well, I'll tell you, like, what I do personally, and what we do for clients, there's a modification, because just we've spoken about, for example, CRDO tonight, which we thought it was an inferior stock in terms of quality of the position, so we didn't own it. But I always start out with the 5% position personally, and I want to go to 10% as soon as I'm proven that I'm right. Now it's been a brutal year, and I've been out of the market this whole year so far until recently, primarily. And last year I wasn't in the market much at all, in that downtrend. And but I want to, in a rip snoring bull market, I want to have, and I've got big gains in the market. You want to play with more concentration and more risk as you get profits built up. You don't want to, you're not going to move the needle. If you have 1% or 2% or 3% in a position, it goes up 200%. So personally, I want to have 10 to 20% in new leading stocks that can double. And for example, in Google in 2007, I had a seven-digit year in Google, and I had most of my money in Google that year, and it represented about 90% of my gains. So what you should try to do if you're trying to enhance the performance of your portfolio is you want to get up to 10, 10, whatever you're comfortable with. You got to work the math and say, what happens if it drops 20%? How much will I lose? And can I recover from that? You don't want to be on margin, and you don't want to have something that drops 50%. You've got 20% of your position in, you lose 10% of your capital. That's not insurmountable to make up, but that does put a damage in your portfolio short term, plus your confidence as well. But I don't put anything on unless I have put 5% on personally, and I want to go to 10% as soon as possible. And I own almost all of the stocks that I've showed you that we own for our clients. I own all those as well. I'm fishing in the same pond, so to speak. Right. But 5, 10, 15, 20, just depending on how aggressive you are and if you have any profits built up.
Yeah, I'm trying to follow that Minervini progressive exposure strategy, starting at 5%. And then you win 1, 2, 3, and then you lose 1, 2, 3, and man, I just can't get off the 5%.
And let me show you. See, this is we've had this volatility, and Mark is a friend of ours, and so guys that I'm sure most of you guys know Mark Minervini. And we also subscribe to him. We had a Zoom call with him recently, and we touch base, every now and then. And we were going to do a big get together here in Charlotte at the NASCAR Hall of Fame, but the pandemic changed that. But so we're following Minervini too, and he's been whipped out. And a few of these stocks, you can see the volatility. This is one that he just bought, got stopped out of, on the volatility, ESE. There's the volatility.
IMCR.
And this is, so it's almost as if, and Wes and I have talked about this, it's almost as if people are watching him and they're shorting exactly what he's buying right when he puts a buy recommendation. There's AXON. We took a loss here. There's no news, absolutely no news. And this is a stock that we bought, had a profit in, sold it at a loss because the stock dropped like $16, $18 just after a perfect uptrend, setting up. This is Taser. Post POST, and so there's the volatility, right? That we made a new high, and then that is what's been happening time after time for months and months and months. And there's just volatility. We don't own a lot of the same stocks he owns though for our clients, because he's in a lot of these smaller cap stocks, Tom, and that we don't think are institutional quality. He'll buy, he'll recommend a lot of biotech stocks that don't have earnings, MDGL. And so but we think he's a good barometer, and he's got a great sense in the market. It's just his strategy, and he'll never buy. His strategy has been, it's been choppy. But, he's the best in the business, and he's been chopped up over the last year. How long have you been following him?
Probably since early 21.
Do you subscribe to his service, to Minervini Private Access?
No, I took his class, but read the books and.
I'm a huge fan. The books are terrific. His specific point entry analysis.
Right. The class, yearly class goes through a pretty in-depth.
And Wes and I attended the class a couple of years ago just to say, okay, he's a mentor of ours, and we wanted to just show him a little love. And so we attended the class, but I actually felt that if you studied the books intimately, that there was nothing new in his classes that his books don't cover, but his books are, I hold them to in a very, very high regard. And I think his service is good. It's just expensive. You know, it's $5,000 or $6,000 a year. It's expensive, but it gives you another view. And for us, it's an investment in our business so that we're seeing everything. We want to see we want to see everything. And so a lot of people follow us. We follow the people that we think are the best in the business as well, too, for confirmation.
Yeah, talking about him getting chopped up the last couple of years. You know, he mentions often that, you know, not everything works every time. So sometimes your style works out great and sometimes it doesn't. You just got to live with it, right?
You have to understand that. I remember, well, I was in the U.S. Investment Championship 2 years ago, 2021, and I came in second. And then he was number one. He came in, he had a 300% year in 2021, which is incredible. And that's just incredible. So his methods and tactics, they work. But remember, he's got 40 years, and he achieved that record by having taken huge bets and being right, backstopping his profits, always protecting himself. And he's a master at managing the downside. He's great. And, but understandably, his style's been out of favor. And I'm excited because I'm seeing, so I think his growth is going to come back in favor. And I think we're just at the beginning of the turn now, because it's been brutal to make money in the last 2 years. It's just been, almost impossible. And now I think the worm has turned.
Hey, Roy, this is Steve. I had a question, but I wanted to go over one thing on the semiconductor ETF first.
Yes.
So a lot of people look at the SMH and it's market cap weighted. I personally use XSD. And what I like about that is that it takes from the S&P 500, 400, and 600, and it equally weights the semiconductors in the ETF. So you'll have an onsemi or an ALGM being equally weighted with, say, an NVIDIA or a Broadcom.
What's that symbol again, Steve?
X as an S-ray, S as in Sam, D as in dog. So XSD.
That's fantastic. Thank you for that.
Yeah.
So that's an equally weighted, and just like that TSM is the number 1 position in the SMH, and that put pressure on it. But you can see the equally weighted just held in great today.
Yeah, and well, the interesting thing is actually had Credo in the portfolio, but as bad as Credo was today, the SMH was flat, and this was down 25 bips. So still having enough, like about 40 holdings in there, it held up well enough. So hey, the question I had was,
it's not very liquid though. Look at the liquidity.
But it's an ETF, and you'll look at it, and what'll happen, I noticed with the ETFs, is that if you have to buy a big block for clients, it's kind of like almost you have to look at what the last print was, and then you have to look at the bid ask. And sometimes the last print is not where the bid ask is because it hasn't traded a lot of volume. So you might have a 205 print, but the bid ask is like 206.5 to 207.25. So you just have to kind of look at the bid ask before you make a purchase, so you know where it's at, because the bid ask does accurately reflect where it actually is, not the last print. So you just have to be aware of that on the up and down side.
Thank you. I think it looks terrific. Thank you for that. And I think it looks terrific. And we actually have the SMH on our focus list, and we could definitely put this on as well, because I like exactly what you said in terms of, we have the RSP, which is the equally weighted S&P, not, taking out big cap tech. And so this is the same type strategy that you're talking about. You know, there's an equally weighted S&P taking out, you know, the big boys, or not taking
Yeah.
them out, but equally weighted. So I think that's I really like that idea, Steve. I like that. I like this better. I like this better. I like this better than the SMH. Thank you.
Okay. Yeah, no, you're welcome. So, hey, the question I have is that I own a couple of the same ones you have, like an Airbnb and Uber, and I again got in them over the last few weeks. What's like, again, we have a lot of excitement. We're in a bull market, things go right. And I agree with you that these are, potential new leaders that can really, double or what have you. But what's your strategy? Just so I understand from your perspective, if things go wrong, things sell down, do you have a, like a 5% stop on each from your buy point? Do you do a little bit like what Jim Ropel does, where you do like a 3, 5, 7% stop? I mean, what's your, or is it further down? What's your strategy with some of these?
I did, Jim's a friend as well, a friend of what we do. And we're, he's got a really nice service, Growth Stop Mentor with Adam Sarhan. And I definitely use 3, 5, 7 personally. Well, I'm very aggressive and quick on the trigger. Most of the time, if I'm in something, I'll have a 3% stop personally, but you can't do that. You can't do that when you're trying to build a portfolio where we're trying to get some of these leaders. And Ropel, once he's in the position, he's going to hold the position forever until it violates his cost basis by a significant amount, by 3, 5, 7. But, Ropel's, he's not interested in making 10%. He's made all his money in companies, made millions in Broadcom, over the last 20 years. And, these monster stocks. And John Boyd, has, he's got a number of great books. He's got one called Monster Stocks, Lessons from the Leaders, Lessons from the Great Investors, and things like that. I think I was actually in his last book in a small piece, but we're using like 5 to 8%. And then, but a lot of times these stocks go down 10% overnight, and you just get kicked out. Things happen. But from a personal standpoint, particularly if you're full time, you're sitting in front of your screen. I use things like prior days low. I'd like to buy stocks right when they come in and they have their first up day, and then you get into the position with a 1 bar stop. And so I'm not even looking at the percentage. I'm looking at, okay, the stock comes in and then it turns up. And you add to the position using a 1 bar stop, the low of the prior day. The low of the prior day once the stock turns.
Gotcha. All right. Thanks, Roy.
You're welcome. And a perfect example, this is a perfect example where we don't care what the position is. We're using the stop at yesterday's low. See where it finally turned? And the stock's down from 1250 to here. So, the buy is buying it, taking out today's high, using yesterday's low as a stop. So that's where you get that's where you can tighten up your stops, but these are like pullbacks, not necessarily breakouts. So, any stock that breaks out and, takes out the pivot, and it's down, 8%, we're out. So I think we keep our average loss 5 to 8% over the course of 100 trades. That's what we're trying to do. And then, now that the market's turning, you're going to want to have your losses at 8% and your profits at 20 to 25%, 3 to 1. And you haven't had that type of risk reward in a year and a half, certainly in growth. Now we think that the time's here where you can still get stopped out, but you're going to have some of these stocks that go up 20% too. but you also want to have the same concentration. You want to, for stocks that go up 20%, you want 5 or 10% positions to make it meaningful.
Roy, what's your thoughts on this whole AI craze going on? Is that going to be an emerging theme, you think, or is that just like a?
It's been here. I bought this AI 2 days ago. See, on the turn into see the stock, got hot. This company is owned by Tom Siebel, who's made fortunes for many investors over the years, but he had Siebel systems that he sold, I think, to Oracle. I think it was to Oracle, I'm not exactly sure. But there's the pullback buy to the 21-day. And the chat GPT, I guess that's it, chat GPT is this has been around, it's artificial intelligence, Google, Baidu, everybody, they all have Amazon, they build their business on artificial intelligence. That's not new. It's just chat GPT, I think. It's just been, it's been a buzzword. So you can't, this stock, by the way, is 30 million shares short. And so I bought this stock 2 days ago on the pullback using that low as a stop. Now that I have a profit, I'll move it to break even. But you take out that level, see the line that I have drawn, you take that out and you can get a short squeeze that it could be powerful with 30 million shares short. And you have some of these baby players, SOUN is one. What's that? BA, what's the other one?
BBAI, I think, or something like that.
See, Joseph, all the.
Oh, it might not be that one. Hold on.
That's it.
Oh, there it is. Yeah, it is.
So I think, you want to go with Tom Siebel, if you're going to play this, and it could be a hot theme. Baidu's the Chinese way of playing it. And, but you want to see products, AI launched a new suite of products. Look at the institutions. Look at the buying demand. See right here, the volume. So this is, this is clearly, you're betting on this is the leader. You're betting on, this is who you're betting on. You're betting on Tom Siebel, who's got, I think, I don't know how many million shares he's got. He's got a bunch, he's probably got, not sure, but, I'm sure he's got 10 million shares probably. But there's the momentum, there's the turn. And, companies like this, I'll give them one shot, but it's too speculative to put in client accounts. But that's the move up. I didn't buy it on the way up, bought it on the turn 2 days ago. And so it's just a speculative trade that could, you could get lucky with something like that.
Hey, Roy, what is your opinion on Tesla?
Boy, that's.
I own this one, Roy. Don't say anything bad. I own this one from 158.
I just can't believe. I've never traded this stock successfully, and I can't believe that I missed the move just because it was so hated down there at 100. And, I just missed the trade, and I don't know where it goes. The stock's doubled off the bottom. You only need to have one of these a year. That could have made your year right there. Particularly if you had it in a concentrated portfolio, if you had 20% of your equity at the right time, and that's really how you compound, but you got to take the risk. You can't make money unless you take the risk. But 20%, having 20% of your capital in that stock at 100 with a tight stop after it getting washed out wouldn't have been unusually risky. And I don't know where it goes here. It's in an uptrend, and they cut prices. they lowered the prices by $30,000. And I couldn't believe that that's going to impact their margins. I couldn't believe the stock would go up when they're lowering their margins, just like when Intel peaked in 2007 when they started cutting their margins. I can't believe it went up. I have no idea where it is now. Maybe this is going to, Charles Harris is he's a friend of IBD. He manages money for O'Neill, the institutional side. And he's made a fortune on this stock and lost fortune on it. And, maybe this turns into like an Apple over 15 years. I mean, so there's your pullback to 100. And maybe this stock over the next 15 years, there it is. The stock's only moved, 3 years. What if this stock turns into an Apple and you get a 15-year run as they change the way that business in the storage industry, with their technology and autonomous driving and all that, as it becomes ubiquitous across the land. So Tesla, there's a possibility, maybe this turns into the stock that you should own for your grandkids and for your retirement for the next 15 years. You certainly have you've got a genius running the show. Yeah, go ahead.
Don't you think Apple, when it came out in 2004 with different products over next 5 to 8, 10 years, that is what propelled its growth. What is Tesla coming out with? I mean, they have a good EV car, which other manufacturers are also doing, and market is getting flooded with a lot of EVs right now.
Yeah.
So apart from their best navigational system, which hopefully they have world class system out there, what else are they bringing to the market? Nothing.
Well, there could be some they own a solar company, and there could be, a lot of changes in technology in terms of the battery, in terms of, the, energy storage, autonomous driving could be huge. So I don't know.
So what I'm trying to say is Tesla had an advantage in autonomous driving in last 5 years, which they are losing to other companies now because everybody is coming up with that technology. What they should have done was license that technology and let others use that. They could have made a lot of money with it, just like Netflix would have done it for the streaming. Yeah. But Netflix lost the business, and now we see what is happening with Netflix. And I think same thing will probably happen with Tesla after a year or two from now, if they don't innovate into something new.
And that's why I haven't bought the stock, Yogesh, because I feel the same way. With competition, Mercedes, BMW, great, the Chinese luxury cars, the EVs, Lucid, all that stuff, they're beautiful. And so that's kept me out on this run here, because the stock got, hammered. But, maybe, I think the stock has moved up, even though they cut prices, by, 30,000 of their top of the line car, because I think now I saw a survey where now 84% of people that are in the market for an EV, they're looking exclusively for Tesla because of the price cut. So demand is ramping, but you're going to see that impact on margins. But I'm just looking at the numbers, and I can't get excited when somebody cuts their prices 20 or 30%.
Yeah, but that's just applying more pressure to the legacy auto companies.
Yeah, and
Tesla's margins still dwarf other manufacturers' margins too.
Yeah, the question is, the bears on the stock are going to say, well, look, how can you pay 51 times when everybody else is, when the PEs there's PE a 6 of General Motors, Ford, and so the bears are going to say that, man, this is just a car company. You don't deserve a 55 multiple. That's what the bears are saying. And I think it's a battleground. You had a great trade there. I'd be out. I'd sell it on this run. If I bought it, I'd sell it right now, right here at the 200-day. If I'm out of it, excuse me, if I'm in it, but I'm not going to buy it because, it's got tremendous overhead and it's trading, how many shares did it trade? Does it trading a day? Millions and millions of shares. And I don't want the battleground, 175 million shares. And that is short covering. And no, I don't care why the reason the stock went up, but that is short covering. And, if you're a bottom fish player, I was talking to Wes about this, Google has gone down at the expense of Microsoft going up because of AI, chat, GBT. And, this wouldn't be a bad stock to own down here, for quote, a bounce play, but the bounce to the 200 days only 7%. And I wouldn't tie up money here at 7% when you're trying to get in stocks that are going to go up 25%. This is going to take this stock a long time to go up 20%. It's going to trade like the market is trading.
Roy, can you please pull chart for ACLS?
Well, who's this? Amit, who's the stock? What's the stock?
ACLS, XLS Technologies, ACLS, S for Singapore, yeah. Roy, so I'm pretty new to IBD, just a month and a half. So
okay.
when I missed this move from $80, I noticed like it broke out at $80, and I got like second chance, and I have been watching at like around 9900 level. But based on IBD, that was not kind of a perfect entry point. And if you look at that, it has been up almost like 30%. So when a stock like this, which can be a great leader in future, what is your normal strategy? Like, you still take position at, let's say, like 100 and then keep adding, or you will wait for another like base or pullback?
Thank you for that question. I'll answer that with a couple of possibilities. When you get a stock like this, that is a potential that's a potential market leader, that you have this kind of powerful action, and this happens just occasionally. Many times say if you bought that stock at 80 on the 89 breakout right there on the trend line that I've got, taking out the pivot, and you had some pocket pivots down there, then you could use a stop. One way of doing it is use a stop to protect 75% of your gain and just put it in. So, now the technology, depending on where you trade, you could put in a stop to protect 75% of your profit and then forget about it. You could do that, or you could sell half. For example, now the stock, how much is the stock above the 50-day? The stock is 32% above the 50-day, which is pretty extreme. And so you could sell half and then, and then let the rest go, let the rest go at break even and hold it until, hold it for weeks or months. You're using the house's money. So that's another way of doing it. You can protect 75% of your gain. And most of the time it's going to pull back, but that stop is going to be low enough so that you don't get kicked out unless it really rolls over. So that's how I've done it over the years. But, you get a gain here, 90 to 129. When you get a move like this, O'Neill used to say, he had the 8-week rule. When you get a stock that moves up quickly, in a few weeks, 3 to 4, that moves up 25% in 3 to 4 weeks, you hold it for at least 8 weeks. And what that does, Amit, was that Amit?
Yeah, Amit, yeah.
that allows you to get the next earnings report. See, the great winning stocks, they beat and raise their quarters every 13 weeks. So that's going to keep you in. So that's a great way. I mean, you've got a winning stock here. So O'Neill would say hold it for 8 weeks. So it just depends on, depends on how you want to handle it. So there, you could sell half, hold half, use that 20%, protect 75% of your gain, use that methodology, or you could wait now until it closes 2 days below the 21-day. That might suggest that the top is in. So a lot of stocks come back to the 21-day, and if they don't hold the 21-day by day 3, many times the short-term moves over.
Okay. Sure. Thank you. Thanks, Troy.
You're welcome.
Roy, what about this one's kind of interesting to me on the weekly. Well, I guess on the daily too, is Spotify. It's breaking out as stage 1.
Yeah.
It had a 10,300 on earnings, breaking out of a little stage 1, and Fidelity Contra funds in it. So I've just been kind of watching it, but I mean, I know it has a lot of overhead, but
look, the setup is justifiable, and you can't see it. You can't see my pad here, but Spotify's on it. So Spotify's on it. So it had that 10,300, and so the market is forgiving these. See now, and that's on the earnings report too, Joseph. See, you got confirmation. There's your confirmation. It actually went up. That earnings report, the one before, went up there, and then the stock corrected, and there's your 10,300, and so and that's what I'm seeing. See, I'm seeing this work now. It's in a stage 2 uptrend, and there's overhead. You don't want to have a whole portfolio. I mean, I mentioned 2 or 3 that we have. You can put Brothers in there. You can put Toast in there. I mean, there's nothing wrong with this is exactly how stocks bottom. But what's Zoom like, for example? See, Zoom's not doing anything. Earnings are in 12 days. Teladoc, but wait for the earnings. See, look at Teladoc, see turning here. And this is what, so I am aware that this is what the bear market bottom looks like in stocks that have been beaten up, that are down 90%. This is how they turn. And you're seeing that time after time, in stocks, like there's Service Now. See, it bottomed in January. See, now it's above the 200-day. And, this is, so they're, that's what's happening. So these stocks are turning. There's nothing wrong with this, but you don't want to have a whole portfolio of this because of the overhead. It could get stale quickly. Datadog is tomorrow. And so, that was, I'm just seeing better action here. And I'm not buying these necessarily. I'm looking for the ALGMs and the ACLSs of the world.
Roy, this is Sujay. Do you mind looking at NET?
The same stock. So this is on my list as well. And there's the earnings report. See, now you have this. No, this is interesting. And Wes actually bought this 2 days ago, right there. And on the Goldman initiated coverage with a sell on it. So imagine you've had this stock that's been hammered from 200 to 40, and Goldman initiates it with a sell, and Wesley bought it right there because of the turn, because it's turning. And
what said is true. That's what was confusing, because Goldman initiated a sell, whereas the EPS is up, and the last earnings they got in a surprise a positive earnings. So
Yep,
and the revenue has been up.
So that's, so there's the catalyst, and look at the volume that's come into it. So you cannot ignore that volume. So this is what's like, and look, this has only changed 4 days ago. So I'm waiting for, this is something that we've just seen, where now I'm seeing stocks that are performing regardless of what the averages are doing. So, you want to see how this stock bases when it, if the market, if the indices come in, and you don't want to see the stock break the 10-day, it could come in, but the stock is definitely turning, and it's an institutional stock too, $24 billion, and they're profitable. So there is definitely room in your portfolio for some of these, regardless of, if you're going to be a quote IBD, pundit. This is how the turns happen after bear markets, when beat up stocks happen. But you don't want to get the wrong one, the ones that don't work. But that looks interesting.
Yeah, one more of these beaten down ones, DraftKings, DKNG.
And earnings are in 1 day. I guess you're going to find out tomorrow.
Yeah, we'll find out tomorrow.
But I don't like the numbers at all. They've lost money for 5 straight years. And I would prefer, if I'm going to buy one of these, we'll see what people bought it because of the Super Bowl, right?
Yeah.
And how much betting was on the Super Bowl, yada yada yada. That's not, in my mind, that's a one-time event. And it's not, in my mind, a reason to buy this stock at all. I don't really like the business. They're losing money for 5 straight years. I'll pass on it.
Thank you.
You're welcome.
Roy, you might kill me for buying this stock today, but I nibbled at Palantir.
It's same kind of setup. It's a big company with 21 billion. And look at the accumulation, Joseph. So where does it go? No one knows, but you gotta, yesterday was your buy point. There's your, actually, you know what? Wes and I were talking about this. This is the only stock that I can remember that you had 2 10% up days with volume 300% higher than normal, back to back.
Yeah. No, I bought it at the open today, pretty much.
Yeah.
And my stops, if it comes down to where I bought it, I'm just going to cut it. It's either going to go or it's not. You know what I mean?
It's definitely a legitimate, and it's down from 45 to 5, 6, 45 to 6, down 90%. So you don't want to get trapped. You get a little trade, get a 20% trade and get out, of it. It's not, this isn't a new leader or anything like that. It's a very expensive company that I have not read good things about from their business. They've got government contracts, but I understand they don't have the best technology. That's why the stocks dropped 90%.
Yeah.
No one's talked about Celsius. So Celsius is going to report March 1st. We've tried this a couple of times, and we'll see if it's the third time's the charm. And with the distribution agreement with Pepsi's also got an ownership, and I've been drinking Celsius drinks. Can you guys see that?
Are you concerned that it really? We've been rallying off the bottom, but it looks like it's just going towards the 200-day. Maybe it hasn't really been.
Doesn't it look like there's a problem? It looks like Shockwave.
Yeah.
Which was a leader. It looks like LNTH that blew up. That was a leader. Looks like Enphase. See, these were all, notice, see all these stocks that I'm pointing out, they were making 52-week highs, and the stock, they weren't ready. It wasn't ready. The stock wasn't good, or the market wasn't ready. And in this case, it's probably a bit of both. And I mean, in phase, we doubled up at 325. We doubled up at 325.
You're right. It's in December. That's when it was. Yeah.
Yeah. Taking out the trend line. There's Wes. And, and immediately got stopped out. And it wasn't ready. And now maybe, so ANET just reported. We got kicked out of ANET here thinking that this stock was, well, it was a leading stock, but the market wasn't ready. You know, look at where it broke out to 52, 52-week highs right here. Then it immediately reversed, got hit, and now it's come all the way back. And there's the earnings report yesterday. And so now the stock might be ready and the market might be ready. So the environment's changed. So you're getting some of that action.
Rory, have you looked at AEHR?
Yes. Charlie, we looked at this earlier. We don't own it for clients because it's so thin, but I bought it 2 days ago on the reversal. And, it reported a great quarter. There, I bought it right there on the pullback after they announced that marketing offering. And it could, we'll find out, we'll see if it's got enough power to go to 52-week highs or not. It's definitely a second tier name. It's tiny, but so position size accordingly. Look at the numbers. They're only doing 15 million in revenues in a quarter. But maybe maybe the technology is going, maybe someone will buy them out. It's less than $1 billion company. Not many shares outstanding. This could be a huge winner for sure. It's thin. It doesn't have much institutional sponsorship, but it's got a 99 relative strength and a 99 composite. That's as high as you go when you're looking for stocks. This could be a hidden gem, Charles.
I'm not familiar with anybody doing a secondary in the way they're doing it. What typically happens?
I've never seen it.
Yeah, I don't like that you can't clear the air, right? Because they don't have to announce that it's completed. That's what's kind of confusing to me.
Yeah.
Thank you.
Normally you price a secondary in the hole. So when people announce a secondary or a subordinated debt offering or something like that, then they priced in the hole normally down another 10%. And normally, but here they said they announced a secondary where a market offering where they can sell at the market at any time. And so you don't know. So you don't know when you don't know when they're out of it and how much pressure they're putting on it. But that's only about 700,000 shares. So but they're announcing it. Maybe they'll sell into strength. Maybe they're announcing it before the next leg up so that they can sell it at 50 or 60. And then the paperwork's in. So you don't know when they're going to sell.
Thank you.
You're welcome.
Roy, could I get your opinion on CDW?
And that's I'm not familiar with it. Broke out to a 52-week high. You had a great earnings report. It's acting good. Let's look at the earnings. 20%. They're doing $10, $11, $10 this year, $11 next year. $28 billion, an IT firm. So I guess they're a consulting firm.
Yeah.
And numbers look good. Look at they're doing $20 billion in revenues with the price to sales of 1, which typically is very, very cheap. And you've got a lot of people in here, and this is this is a 89 relative strength. It's improving. What's it look like with the overhead? Look at that. So this is one of these stocks that's been a long-term winner that's just breaking out. And technically that's very strong. Looks really good. Stocks that double, typically have to go to new highs, and that's the easiest way for them to double.
Have you looked back at SMCI?
Yeah. And we owned it and got stopped out. Look at how it tried to go. It got extremely volatile. I don't really like it. I don't, the idea. Oh, this dropped on a short sellers report.
Yeah, there was a report.
Yeah, did they potentially have fraudulent accounting statements and so forth? So I like, why bother? Why bother with when you have that overhang on the stock? It's acting poorly. Look how whippy it is. The numbers are fantastic, and we own the stock. We actually owned the stock. I can't remember where we sold it, but we got stopped out. I'm not sure.
I can't remember either. If we
They're there, huh, Wes? One of those.
Yeah, the short report. Which one was the short report? Can't remember if it was the first gap down or second gap down. I think it was the first gap down. Did we? I guess we may have bought it that day and just sold it the same exact day, right? Where it peaked at 92.80.
Yeah, we could have. But I definitely would pass on it with the volatility, and it can go to 180 without me.
Okay.
Because now it's tarnished in my view. Why bother? And short sellers, they're notorious. I mean, they've got their position in, but and I don't have any problem. They're talking their book. That's what Wall Street is doing on the long side. They're telling you to buy the stuff that they favor, and short sellers are telling you to short the stuff that they think is overvalued or exposed. Look at FTX.
Yeah. Another one is FTNT. Have you looked at that one? It had a good earnings.
So great earnings report, and right now, coming off the bottom, the leaders. You've got 4 leaders in this group. You've got Fortinet, Palo Alto Networks, CrowdStrike, and who's the last one?
Zscaler. Yeah.
Zscaler. So there's the earnings report. It came in 2 days, held the gap, it's pretty much holding the gains now. The earnings are out of the way. The market liked it. So now this stock, but I don't like this stock, has got a lot of overhead too. But it doesn't look that bad right there, does it? Looks like it's breaking a downtrend line. Sort of like right there. And the stock went up on the number. That's all that I care about. Did the stock go up on the number, or did it go down on the number? And do I have a runway of the next 13 weeks to try to make money? So there's Fortinet, there's Palo Alto Networks. See the same kind of move. And there's Zscaler at the 200-day, and this is so. Your play here might be CrowdStrike. So look at CrowdStrike. That was a leader, and we talked about it from the IPO phase. But for whatever reason, CrowdStrike is really lagging Fortinet, Palo Alto Networks, and Zscaler. But here, it's institutional quality. It was the leader. So you do potentially have a trade to 150. So you have a trade of making 15%. The 200-day is 20%. So you can, you could, that could definitely be a catch-up trade, but you do have 20 days to earnings.
Sounds good. Thanks.
You're welcome.
Roy, can you? Mhm.
Yeah, let me check that. This is a furniture company, Air House, that's sort of like a competitor to RH, Restoration Hardware. But what's interesting is this stock is an IPO. It's gone, came out, got hit, it's coming all the way back, and it breaks out at 15, and they have really good numbers. It's too thin to buy for institutions. See, it's only trading $15 million a day, but this breaks out at 15. And look at that's where somebody bought it big right there to get it going. And so you might watch, this is in the camp of like that AEHR. Earnings are in 22 days. And you have had some good numbers like from Ethan Allen and Hickory Furniture that have been good. And this is an upscale furniture storeroom that breaks out at 15. So keep your eyes on that one.
There's one Elf Beauty, ELF.
Well, this has been the poster child. So it's a cosmetic company with cheaper cosmetics, and what I'm telling you guys is a lot of these stocks that we featured tonight, they're going to be like Elf Beauty when you look out a year from now. Look, so the move from the June bottom got above the 200-day. See where we're looking at a lot of these stocks that are just getting back over the 200-day, like that. So you got your buy signal coming back over the 200-day. There's your pocket pivot right there at 31, and then it's a $70 stock. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months. So that's what we're in. This is what we're in for, in my view. We want to get the next Elf Beauty. It's extended. There's the earnings report. It went up. Apparently a well-run company. It's one of the leading stocks. And you ride the horse until you have to get off. And you did have that break right there where you got everybody stopped out coming through the 50, and it reclaimed it. So this could be a big stock. I don't know much about it, but the action is fantastic. 99 relative strength, composite 99. So it's got the best of the best fundamentals behind it. You got institutions in. This is it looks fantastic.
It can still be double from here.
Yeah.
Okay.
Yeah. I think if we're at the beginning of this market move, you're going to, I'm telling you that some of these stocks can go up 200, 300%. And, this stock can go to 150, but they have to continue to, it's not going to have overnight. The stocks are going to go up based on the earnings growth. And you're going to want to have stocks that consistently beat and raise their numbers. That is what you're focusing on. That's the only thing you need to look at, stocks that are beating and raising their numbers, and the stocks are going up. And Wall Street continues to reiterate a buy on the stock. And you want them to raise their price targets. You want to do that quarter after quarter after quarter.
Sure, yeah.
Yeah, this should be on everyone's watch list.
There is one more MNSO, M for Mango, N for Nancy, S for Singapore, S M
I'm sorry.
N
M.
M N N for Nancy. S for Singapore. M N S O. S for S for Singapore. MNSO.
MNSO, I think he's saying.
Yes.
Yeah. Minoso, some kind of stores. Yeah, Miniso Group Holding.
They're Wes and I were looking, like, we own PDD, so we think this is we own Melee. This is a Chinese company, 5,200 stores, 97 relative strength, decent numbers, a $5 billion company, and excellent earnings. Revenue growth is so. And there's a whole group of these, and Wes and I, we favor TCOM with 600% revenue growth this year expected. 600% is the estimate for, earnings growth for this year. And you can see it's got, so the earnings are going to be great this year as China opens their economy. But this is a second tier name, and the leader is, the leader's Baidu. Baidu, look at it above the 200-day, and they've got the benefit of being in the artificial intelligence area, in China, and they're in self-driving, autonomous driving cars as well. There's the leader, but earnings are in 7 days. But, you got Baidu, JD, Baba, and, Baba's pulled back to the 50-day, and we own PDD. So the numbers on PDD are better than Baba. So that's why we own this one. So you want to just narrow it down. I don't think you want to have 4 or 5 Chinese stocks, because if there's some type of censorship, if our government puts tariffs on China, if we shut them out of our market, then you're going to see these stocks plummet. So, I would keep it to I'd keep it to one. We're keeping it to one.
Well, at least this is so big too. It's 120 billion. So you can, rest a little easier there. And I think Ropal pointed out today, it's funny how it looks so orderly, the pullback to the 50-day. He said as if somebody's defending it. It's interesting to see it just bounce and see support so clearly at the 50-day.
And, so we like this one where I think I said before, where you buy it here and you double up, taking that trend line, out. And
hey, Roy,
barely shows. Yeah, go ahead.
Roy, could you look at Perion Networks? I opened the position.
Mike Myers, how are you, sir? Good to see you. Where you been?
I'm good and getting better.
Good.
Really enjoying the call here tonight.
It's so good to hear from you.
Absolutely.
We're gonna have to go. We'll have to go out and get a beer, Mike.
Yeah. We'll schedule it for beer 30.
Okay. Beer 30. What's beer 30?
It's every 30 minutes on the hour.
Oh. Well, unfortunately, I can't have a beer while I'm going through the call, so I'll have one. So this is an advertising company, and we sort of like the company, but it was thin. It's a $1 billion company. Numbers are so, but the action is good, and you can see where it got on our radar right here at 28, taking out that pivot.
Right.
So right there's your buy point. Now, this is the kind of volatility. I don't think there was any news like that big down day. And that's the kind of volatility that we've had that you don't want to see. But it is recapturing this in only 4 days. So it's recapturing the drop it actually did it in 3 days. It recaptured the whole drop and now it's above it. So that this is showing you, this is a very powerful rebound. So, and you're getting, look at the 1, 2, 3, 4, 5 straight days of higher than normal volume down at the bottom. So people are definitely buying it. And I don't know the fundamental story, but it came all the way back. And this is what it's a small company. And this could be, this could be turn into a big winner as well. I think it's definitely interesting. Trade desk, you had this buy stock, and we're going to buy this stock tomorrow if it pulls back.
Yeah, that's the same space, right?
Yeah, same space. And this is the big institutional one. See, look at the institution. You had the volume was up 600%. The stock was up 32%. And so you take a stock like this, and
I tried that in the 90s. Yeah.
Yeah, and see if it'll pull back. See, there's the pullback. I wasn't watching. There's your pullback midday today, where it came in right there midday and turned. I actually was at the dentist right here at noon, so I didn't see the turn. But there's you could have bought it right there. There's the breakout, the pullback here. Now it's extended, but if it comes back, say it comes back to here to say 64, 64, 63, tomorrow we're going to buy it. So 64, 63. And then if it takes out today's high, I mean, ideally it takes, comes in 3 or 4, and then it takes out today's high, and then you press it.
Right.
So that's exactly the way to handle it. And the price targets are $80, $15. And this should have been a buyable gap up. This is one. I mean, it was showing up. Stock was only showing up like $3 or $4, and it closed up 16. So you can't kiss all the babies, but this has great action. I think this is a better institutional favorite. And you've got millions and 4 million shares trading $250 million today versus Perry, who's a little child, trading $12 million today, 250 versus 12 million. You can see what the institutions bought today. They bought TDD. TDD might buy a company like Perion,
And my wife's got a little bit of Quinn Street, which I think is also the same neighborhood, QNST.
And that looks media marketing, media programs, a tiny company that's turning the corner. It looks like, really good action, price wise. You had some big down volume days there. What's the 52-week high? So that's turning the corner. Companies like this could morph into new leaders. It's gone sideways for 10 years. Wow.
Yeah.
When this stock eventually, if this stock eventually gets there, you're going to see a powerful move. After going sideways for 10 years, you're going to see a double on this company. You got a double almost to the breakout, with 25% of the breakout, and then it's potentially can go.
It's been a lot of sideways. But
if we're if we're in this new uptrend that we think is going to be sustained, you can see all these companies, Michael, that show up like this and provide. There's going to be so many stocks you don't know what to shape the stick at. But it's really good action right here, I think. Good luck with that.
That could be fun.
It could be. It will be.
Good. Thanks.
You're welcome.
What about some more traditional names such as Packard and United Rental?
Well, we miss your United Rental, which there's United Rental. And there's the earnings report. See, man, what's nice, all you guys you're bringing up like great examples, and we are so early in this. United Rental looks fantastic. Great numbers, an institutional stock, a $45 stock that can go to, 70. So, this stock can go to 1,000. And really good numbers, great institutions are in it. Did you say PACCAR? And did you say PACCAR?
Yes, sir, Packer.
And it looks fantastic. So PACCAR looks fantastic. Taking out 75.27, you press it. If you're in it, there's the earnings. There's the break above the pivot of the earnings congestion. And now you press it at 75.30. Are you in this stock right here?
Yes, I am.
Where did you buy it?
I bought it on the breakout of the earnings call.
Wow, that's exactly how to do it. And now, since you've got a profitable situation, you press it now and go for the jugular at 75.30. Of course, that's not any recommendation. Let me just make that clear. But that's what I would do right there. And Wes, what trucking companies were you talking about?
You mean Old Dominion?
Okay.
That's the
maybe Old Dominion. Maybe. There you go.
Yes, there's Old Dominion on the earnings, the same kind of action. So this is viable, but I don't like the idea that this is coming in, but you would put your stop, when you get these congestions, you put your stop. I don't even know what it is, but you can buy it, you can buy it here, you could buy it, just put your stop right there on that turn date. See, it came in your first turn date. And that's how you really get those stops down to like 2 to 3%. But there's Old Dominion and
Shia we talk about.
So, in this group, and how are these trucking stocks going higher if we're going to have a recession? See, how is it possible? I mean, you're getting a rotation out of stuff like what's Kellogg. Look, you're getting the stuff, this should be making 52-week highs if we're in a recession, and it's making 52-week lows. Post, this should be making a new high. In cereal company, it's not. Johnson & Johnson defensive should be making a new high, and it's not. See, so how are we can go into a recession when the stocks are telling us Coca-Cola should be making a new high? People are going to be drinking Cokes in a recession or not. What are the liquor companies? What's Budweiser maybe? Anheuser-Busch.
Constellation Brands.
Yeah. Yes. What's that symbol? ST.
SPX. Yeah. Z. That's right.
So, these should be making new highs, not new lows. So the market's telling you somebody's got it wrong. I mean, are we going to have the first time that we've had an inverted yield curve and not go into a recession like this? It's remarkable really what's going on. But, we're in unprecedented times. And so stuff is just improving, and it's quite positive. We haven't talked about gold. So gold is, gold looks interesting on the monthly, but remember there's an inverse relationship between the dollar and gold. But if gold can break out, if gold can break out, we're going to own gold there, based on, if gold will take that trend line out and break out, that this is going sideways for 10 years. And you're going sideways for 10 years. This is, maybe you get a move like you had from 2005 to 2011. Where you get just a tremendous up move there. So keep your eyes peeled on the GLD.
Roy, do you ever care for industry group ranking, what Market Smith shows normally, and do you try to be like within certain limit, like okay, only top 50 or top 60, or it doesn't really matter?
Normally the top 40.
Mhm.
And
in your experience, is it possible like industry group ranking is like 150 and stock is still like outperformer, or that is never?
I tell you what, what's normally happens is the IBD 50 are going to show a huge amount of leading stocks. And so the IBD 50, let me show. And so this is what the industry group are showing you right now. This is by number 1 to number 197. So you want to keep your buying like in the top 40, typically, but sometimes you're going to have stocks in the industry groups poor, but you have a star, in a bad performing industry group. That does happen occasionally. So you should look, but those are outliers. Most of the time you're going to find the top leading stocks in the top 40 industry groups. So, O'Neill talks about buying in the top 5. The top 5. In one of his books, I think he's got a book called 24 Essential Lessons. And if you read that, that's what he talks about, the top 5 industry groups. But I think you're going to, like in a rip snoring bull market, let me show you what's going to show up.
I mean, here, if we look at, I have been noticing since last maybe 1 month or so, this oil and gas, it's top rank number 1.
Yeah.
And none of the stock like we were talking about, I think, belong to this category. So that's what I was a little bit confused here. Like this is the top industry group, but it's still none of the stock.
Yeah, and we didn't focus on it, but we actually own the XLE, which the biggest component in here is ConocoPhillips and Exxon. And Schlumberger and the OIH looks interesting too, rather than take the industry risk. See, like Devon a year ago was the number 1 leading oil and gas stock, Devon Energy. And look at it now. Look after the top there in June on peak earnings, and then the sideways action. We haven't been very good with trading these oil and gas stocks. You had Oxy as a leader. ConocoPhillips, Oxy, which Warren Buffett owned. And that's looking toppy. See, oil and gas, there's a big debate here where they're going to have really good numbers, but nevertheless, they've got peak numbers. See, all the oil and gas stocks have peaked because we had $130 oil. So they're going to have good numbers, but they've got peak earnings too. So you got to be careful that the group hasn't peaked. So Schlumberger is the number 1 ranked stock in the market, and they're in the oil and gas area. But I would rather buy OIH, which has all of them in the field service area. So I would keep my purchase to XLE and OIH, and then you get the drillers and you get the oil field service companies, and see if it's an industry move. Just like if you want to buy the home builders that have come back, how are we going into a recession if these stocks are making new highs? There's DHI. And interest rates are rising. Why are these stocks
that's
going
hard
up?
to conceive. Yeah, that's hard to conceive. Nobody's willing to buy homes, and these companies are rising. So
yeah,
what we are not able to see here, I mean, what market is what they can see, I mean, big institutions and all.
It's just telling me the economy is better, that the consumer's okay right now, that 5.25% interest rates are going to be manageable. That's what it's telling me, and that's telling me, and it's confirming that. It's just confirming a better economy than we think. We thought that, from a macro view, that estimates have been cut, people are being laid off, but the stocks are going up despite the cuts and the missed numbers. I mean, Micron missed their number by $3 billion. So when they came into the last quarter, they lowered by $3 billion. They lowered their numbers, and the stock went from 40 to 60. So that's what's going on. The market is shrugging off the bad news, because we've been in a bear market for 2 years in growth. So that is what's going on in the market. The market's shrugging it off. So you have to pay attention now with what the market is trying to tell us.
Yeah. Okay. Thanks,
guys. Just a couple more questions, and we're going to wrap it up. My voice is about to go. So,
hi, Roy. I wanted to ask you a question. I'm new to IBD, not new, but I tried it a few times. These rankings that they have, and this is what we have on the screen, is just shows it. They are lagging, and seems to me. So you have ranking 99, but you look at the chart, and chart is rolling down. In many
can you give me a stock? Can you give me what's the stock?
I don't have specific stock, but if we're looking at oil and gas being number one industry, and oil and gas peaked 3 months ago.
Yeah.
So to me, this rankings they're lagging, or you have to wait until rotation into this industry will come again.
They constantly rotate. The industry groups constantly rotate, and like, for example, let me just point out. Let me find this. And I'll make a couple of points, and then we're going to call it a night, guys. You're going to see a proliferation. Look, this is the IBD 50. And so the IBD 50 is a computer generated screen based on proprietary algorithms. It's got a 1,000% turnover annually. So it's constantly rotating. And so it turns over 100% a month about. So what it's going to do, and you have to watch it, and we're going to pull up the FFTY, which represents the IBD 50. And this is where, in the turns of new bull markets, see, this is where the leadership is. It's right here. So focus not really on the industry groups. I mean, we're definitely watching, we're watching the industry groups to see who the top industry groups are and who's moving up. But if you focus on the individual stocks, this is where the leaders are. See, ALGM, there's Lattice, there's SMCI, MNDY, there's that INSP, there's Toast. Crocs reports tomorrow. Wingstop reports, I think, in a couple of days. There's Rambus. We like this IBKR. There's Taser, Exxon. There's Melly. See, there's Mobileye. This is where this is going back at all market bottoms, and then the turns. I've found that over the year, if you had one list to look at, it would be this IBD 50. But there's huge volatility and turnover, but it's going to get you, just like they have IBD's got something called sector leaders, and that's going to force you into the winning stocks. So there's a Mobileye that we own. There's Schiffer Pavements that we own. So there's Copa that looks like the best airline. There's Uber. There's Dynatrace, had a great report. And so there's that Fortinet that one of the members mentioned tonight. This is where this is golden. This is your sweet spot because it's going to have stocks that have high relative strength. Look at the relative strength ranked. Most of these are above 90. And where's the composite rating? Composite rating. Look at these composite ratings. See, all in the 90s. And the
Yes,
composite.
but if you look at Allegra, number one.
Yeah.
If you look at Allegra weekly chart.
Okay.
To me, it's like very overextended, and this justifies all this 99s rankings, but I cannot pull a trigger to buy it at this
You can't buy it here. It's extended. But look, this is only these. You're going like in a bull market. You can find stocks that go up 13 straight weeks. This is going up 3-4 straight weeks. And so if it is a leading stock like it is, you're going to be amazed that this thing goes straight up, never lets you get in. But again, if you get a 2-week tight where it comes in 1 week, gets inside, and then takes it out the second week, and that's 2 weeks, not a 3 weeks tight, then you're going to know there's a trigger to buy it. So it's extended, but you're going to go back and look. Some of these leading stocks, they go up for weeks at a time. So this is just telling you, this is the number one stock in the market right now, and the price is showing you that. And unfortunately, we missed getting in, but we're going to buy it on the pullback if it'll give us an opportunity.
Thank you.
Hey guys, I'm going to call it a night. It's getting late. My voice is going. Thank you so much for attending. We did record this, so if you're on our mailing list, we'll send you a copy. I'll send something out like reviewing our comments tonight. And I want to thank you for spending time with us this evening. We hope you learned something. I hope that you have a great rest of the year and good trading. And we wish you the best. Thanks for attending tonight, guys.
Thanks, Greg. Great call, Roy. And Best. Thank you, really. Greatly appreciated. Thank you.
Liked it a lot.
You're welcome, guys.
A lot of learning tonight.
Fantastic. Thank you, guys.
Thank you. Good night.